Okay, good morning, everyone. Welcome back. We can go back on the record now. Any administrative matters before we resume cross?
Yes, Commissioner Arconti, good morning. Just one brief administrative matter that goes to the issue of administrative efficiency, and that is when I looked at the remainder of the schedule for today, I noticed there were three panels. The rates panel on page 8, the environmental panel on page 13, and the PBR panel on page 16, for which no one specifically said they have cross-examination. Everyone reserves the right. And the question I had for the commissioner, we don't need an answer right now, would be if the parties don't have cross-examination for those three panels, when we've completed the current revenue requirements panel, which I know the authority staff has questions for this panel, as well as the OCC, would it be acceptable to the authority and to counsel for the parties to simply have us bring up the PBR panel, the environmental panel, and rates panel? They can adopt their late files and be excused unless anybody has any questions. As our understanding, the parties simply reserve the right, and we simply offer that to promote administrative efficiency.
Okay, thanks. I think, can we circle back on that after we wrap
Of course,
this
Commissioner.
panel just to
Of course.
get our bearings for the morning?
Sure.
All right,
Thank you.
thanks. All right. And I would also, just for the other parties, after hearing the request from the company, just give that some thought to get anything on the record or any objection after we wrap this panel. So thanks. So with that, we will resume cross by authority staff?
Thank you, Commissioner Alconti. We left off yesterday discussing late filed exhibit 75, and I believe the company planned to provide additional information this morning regarding any savings associated with the change in the utilization of the facility.
Yes, thank you, Attorney Keenan. Good morning, everyone. We did. So the company went back last night. We reviewed the calculation, worked with facilities management team, determined the utilization, as Mr. Cadwalader had pointed out, with the rental income that is going away, and then the recalibration of the square footage, it does turn out to be a $30,000 benefit to Yankee Gas. So there's a reduction in the rate year of $30,000. So we will include that in the LFE 01 supplemental filing the next run. So thank you.
Thank you so much. And I apologize. I neglected to say good morning and to state my name, which is Kate Keenan, Pura Staff Attorney. We just want to confirm that that was for the space used by Beth Israel and Telestream.
It is for the tenants that are leaving the premises in totality. So we are actually going to submit on the record, we're working on it today, a revision to the Westwood discovery that breaks out the total. And we're going to submit a schedule that will lay this out very clearly for you.
Okay, thank you.
You're welcome.
My next question is regarding late filed exhibit 113.
Okay, I'm there.
Thank you. What was the rent for 157 Cordoville Road during the test year?
Okay, 1 second. So the rent for the Southborough Mass building in the test year was ascribed to Yankee Gas was 447,139.
And what is it in the rate year?
In the rate year, that rental expense is 509,846.
One clarifying question, is the increase in rent between the test year and the rate year as a result of the increase in the percentage of occupation by Yankee?
That is correct. As disclosed in LFE 113, we stated that during the test year, the F06 rate code increased. So the new rate code that was used to determine the rental expense in the rate year was the new F06 rate code, which was 10.82%.
Thank you very much.
You're welcome.
I now have a couple of questions regarding the vehicle expense, and specifically late filed Exhibit 77.
One second, I'm going to it. Okay, we are there.
Thank you. How does the company's fuel use vary over the course of a calendar year?
It's based on the fleet vehicle usage. So the fuel that's consumed is based on the fleet vehicle utilization.
And does that fluctuate throughout the year?
I would expect so. I mean, it would depend on the fuel, the fleet vehicle utilization. So on any given day, runs on empty, they refuel. So yeah, it's all dependent on how often, how much they're driving, the locations, the span across the state of Connecticut, across the Yankee Gas, different locations of where we have customers.
Thank you.
You're welcome.
Looking at
Sorry.
Are the first 5 months of 2025, you provided the fuel cost for those 5 months. Is the usage of those 5 months consistent with that same period of time in the previous 2 years?
I'd have to say no, because again, several things could be different, right? If the locations that a gas ops field employee is driving is shorter between customers or there's more activity during the day, clearly the fleet vehicles are going to get used more. And so there's going to be more fuel used. So you can't really take the first 5 months of 2025 and like compare that to the first 5 months of 2024 and the first 5 months of 2023, because it's emerging, right? Every day there's emerging issues. Every day we respond to customers. You could have a period of time of 5 months where maybe there isn't much activity, but then the next 7 months you have a lot of activity with emerging customer issues. So you have our fleet ops driving on a daily basis more so and consuming more fuel than the first 5 months of 2025.
Are the first 5 months of 2025, is there more usage than there has been in the previous 2 years during that time period?
1 second. Mr. Kruger, thank you.
Yep, I'd like to add if I could, on average, the gas operation on an annual basis is driving over 1 million miles a year. And typically in the first 5 months of the year during the cold months, such as 2025, we did experience a more cold winter than average. So we did respond to quite a few emergency odor calls as an increase over the winter months. And it is typical that, all those fleet vehicles would follow the work as, we did experience a much colder winter in 2025.
Thank you. May I request a supplement to late file exhibit 77, just providing, will you have the June 2025 fuel amounts? Not yet. How about, would you be able to do the last 12 months to date of fuel costs?
I believe so. Yes, we'll work with the fleet ops team to gather that information.
Thank you
Sure.
very much.
So I will just repeat it back. We are looking for a supplement to LFE 077,
Correct.
requesting a 12-month ended May 31, 2025 of fuel expense.
Yes, thank you.
Sure, you're welcome. I would just like to add quickly, though, again, thinking about how we built the rate year, we have to take a representative level of fuel costs. Best information available when building the rate case application is taking the fuel costs that were incurred in the test year and then replicating that for the rate year and what we believe will be a representative value of fuel costs that we expect to incur in the rate year.
Thank you, understood.
Thank you.
I just have one last question, and it's regarding late filed exhibit 81, specifically attachment 1.
Attorney Keenan, before we go there, can I just point out on late file 77 as requested by Pura staff, if you look at your lines below the table 1, where we have the breakout of the increase, you'll notice that the GDPPI escalation factor that we used to go from test year cost as a representative value to the rate year was a 2.42% for the calendar year 24, but the actual fuel cost increased 3.01%. So the actual costs are actually higher than what we used to build the rate year costs. Okay,
Understood, thank you.
thank you.
So turning to late filed exhibit 81, and that's attachment 1.
I have that.
I couldn't tell who was, thank you. On lines 26 through 30, in that attachment, the company provides the SEC reporting expenses included in the rate application, which includes expenses for outside services. Does the company have any internal SEC reporting expenses?
I'm
Well, the
sorry.
company,
I'm sorry, Mr. Shallens, could you just repeat the question? Thank you.
Certainly. It's regarding lines, on lines 26 through 30 of attachment 1 to late filed exhibit 81, the company provides the SEC reporting expenses included in the rate application. And the company shows expenses for outside services, but does not list any expenses for internal SEC reporting expenses. So I'm just asking if the company has any internal SEC reporting expenses.
well, the answer is yes. I mean, we do have to make reporting for the SEC. And so there are, internal costs associated with that. But we interpreted this question as, being related to external costs that we incur.
Incremental to the labor costs. I will add to what Mr. Schoenlitz said, which is entirely correct, is that we have an SEC reporting department. That department does not only produce financial statements and reports for SEC reporting purposes only, they actually produce the Yankee Gas financial statements and reports for our bondholders. So those are debt compliance requirements that are not federal. Those are our debt compliance requirements from our debt holders. So when we're thinking about SEC reporting, they provide a service to build the financial statements, starting with Yankee Gas, which then ultimately roll up to Eversource Consolidated, but they start with the operating companies. So the operating company, Yankee Gas, is getting their allocated share of the financial reporting department that is working on the Yankee Gas financial statements and footnotes for debt compliance requirements.
Thank you. What's the name of the department that prepares the SEC reporting documents?
We can get that to you in 1 second. That's actually on our, it's in the ESCO. 1 second. We're trying to find the cost control center for you.
Thank you.
You're welcome.
Sorry about that. Small font over here. So on a QLFE 034 attachment 1, it would be page 1 of 25. It's 03R. It's listed as financial reporting, accounting research, and renewable. So it's important to note that this group does more, as Ms. Pruda said, than just financial reporting. So they also have accounting research and other responsibilities as well.
Thank you.
And yeah, as shown on that page, so approximately 6.15% of their time was allocated to Yankee.
Thank you very much. Mr. Caldwell has one more question. I'm finished with mine.
Steve Cadwallader with Authority Staff. I just want to close the loop on late filed Exhibit 113. There's roughly a 8% increase in the percent of utilization by Yankee, but the increase from the test year to the rate year is more than 8%. And I'm wondering if that has to do with rate code F06 and whether there's some escalation in that rate code.
Yes, if you could just give me 1 minute. Thank you for that pause. It went from 600 square feet to 2,100 square feet. So there is a slight increase to the amount that was allocated to Yankee Gas as well for that. So the primary driver was the change in the rate code, and then the remaining driver was the change in square footage.
Great, thank you.
You're welcome.
Good morning. I'm Pure Staff Attorney Josh Coker. Please open the revised response to LFE 83, including its attachments. Additionally, please open the LFE 1 Revision 3 version of Schedule B 1.0. Go ahead and you can just let me know when you have them ready.
Sorry, did you say 83 revision 1 or was it SP01?
SP0,
Supplement 1?
revised, yeah, the supplement version.
Okay, sorry. We account for revisions and supplements, so thank you for that clarification.
As well as the revisions for the LFE 1. Yep.
Yes, we're there.
So as you may recall, LFE 83 concerns the company's cash working capital, and it requested reconciliation of the cash working capital components to the applicable amounts in the C schedules. So first, let's look at Schedule B 1.0. The amount listed on working capital allowance for rate year 1 on row 31. That amount is 29,114,000, correct?
$29,114,000. So
Yes.
correct. And that's from LFE 1 Supplement 2 Revision 3.
Okay. And that's the amount of cash working capital being sought for recovery in this proceeding, correct?
Yeah, so just for clarification, because of the timing of the late file requests, we updated late file 1, supplement 2, which is revision 3 to the cost of service, utilizing the original 83, LFE 83, because they were filed at the same time. What we subsequently did was update for those late file 1, supplement 2, revision 3 amounts in the supplement to late file 83, supplement 1, if that makes sense. Because of all the timing, it's sort of circular, right? We have to update the cost of service expense amounts to then reflect that into the cash working capital and then put that back into the cost of service. So once again, to try to be clear, we updated the cost of service as a result of all the late files that had come in and all the other changes. We updated cash working capital at the same time, using the prior, using the prior supplement one, then we updated the cash working capital again to reflect the latest revision 3 for LFE 1 supplement 2 in LFE 83 supplement 1. So we would need to do another cost of service update to reflect the latest LFE 83 supplement 1 amounts into the cost of service.
So, and Mr. Murray, everything he said was correct, so I'm going to take a step back. Your cost of service expenses feed into the lead lag study. So we have to complete the cost of service expenses before we can do a refresh of the lead lag study. So when we submitted our revised cost of service expenses plus the rate base adjustment, the rate base adjustment was still stale because we hadn't completed the lead lag study update for the cost of service. Now we updated the lead lag study, and your question is the amount that's included in our full LFE 001, the latest supplement, that's dated now because we just revised, which came after that, the lead lag study. And that number that you're asking is actually, if you look on page 2 of LFE 83 attachment 1, that new number that we're now going to include in the LFE 01, because again, it's circular, it feeds into itself, unfortunately. So the new number is now 28,169, which, as Mr. Murray indicated, now needs to be updated there. So we're certainly not ignoring it. We want you to understand that. It's just that it's a timing issue. So now that is getting fed back in.
Yeah, we tried. Oh, I'm sorry.
So to confirm, just to make sure I understand everything correctly, your cash working capital request is actually the 28.16 million in LFE 83, the latest version of that, as opposed to what's in LFE 1 at the moment.
Exactly. We'll do a refresh again, as we will do all the way up to the final decision. LFE 01 will ultimately reflect Pura's final decision, which will have everything updated, correct?
Thank you.
You're welcome.
Okay, so let's look at LFE 83, supplement 1, the schedule H-1.4. On line 43 of that schedule, labeled CT corporate business, in column 6, labeled expense including rate increase, it reports an expense of $10,504,000 for the CT corporate business tax. Since there's an expense associated with this tax, does this mean the company is projecting taxable state income for the rate year for the purpose of calculating its cash working capital?
One moment, let me tie that back to the detail. That is, no. So the calculation that we're showing there is the corporate business tax increase associated with the revenue increase. So the revenue increase that is included in the rate case application is 174 million as of the refresh, which is getting pulled from, let me see if I can get it on the record. If you go to, Garrett, you go to your A 1.0. Go to A 1.0. So if you go to SP02 of the refresh LFE 001, and you go to A 1.0,
Mhm.
and it is line item 25, you will see 174,125 there as the revenue increase. That has an associated tax impact. So we have to flow that through the lead lag at the state tax rate. So that is your 14,365. That is included in column M on line 43 in your Connecticut corporate business tax. So it's the tax gross up.
Tax gross up.
Let me restate that. Those are the taxes associated if we get the full revenue increase. I just want to restate that. So strike the record. It's the with the revenue if it's approved. Go ahead, Mr. Murray.
Sorry about the squeaking. So yeah, so this in column K, or it's labeled column 4 as well. That's prior to any rate increase. What column M represents is the impact of the company's recommended rate increase. So if the company were to get the $174 million as shown on LFE 1 Supplement 2, there would be additional taxes the company would pay on those additional revenues through that rate increase.
So I guess that this is Ryan Papp with Consultant Appear staff. So I guess our original question still stands. For purposes of the company's cash working capital calculation, is the company assuming that it has taxable income from the state?
You just give me 1 minute because what I do want to add is, this is a tax question. In our lead lag study, we excluded deferred taxes. In rate base, deferred taxes is in there. So let me just walk through that with you because this includes cash consequences based on current taxes, your deferred taxes, and I need to talk to my tax expert. So I can break it down for you because within your rate base, you have your deferred taxes that is included in there. The cash working capital is additive to the rate base for your cash items expectations. But please give me 1 moment because this is complicated. I want to explain it properly.
During the low, could I ask where we are? Late file exhibit number
Late file 83.
83? Thanks very much.
Thank you for your patience. Rate base. If it's easier to do a read-in, because I want to walk through it very carefully, because I know the question you're asking, I know what you're trying to determine, because I want to show you the cash working capital that's in rate base, the tax consequences of the decisions we've made in the lead lag study is to only include current but not deferred, because we deem that non-cash. We did not include any non-cash items in the lead lag study. Your rate base has your deferred tax portfolio in it. So if I can take a read-in later, if possible, commissioners, we can walk through carefully how you are representing all of that within your rate base. In terms of, we do expect to not have a tax liability in the rate year. That is correct. So I will walk you through that.
So just to make sure I understand, even assuming the company's revenue increase is granted, you would still expect to have a taxable loss for state income tax purposes.
That is correct. And that's represented in your SFR schedules C 3.37 and C 3.38. C 3.37, I believe, is all right. C.37 and C.38 is the combined current and deferred.
So just to confirm for the record, do we have permission to allow Ms. Peruta to provide as read-in number 7 the information that Mr. Pfaff and also Attorney Coker had requested?
Yeah.
That'd be acceptable.
Our Attorney Coker, could you, so I could take notes, just articulate again the read-in request?
Sure. Let me see. Provide a supplement to LFE 83 that explains why the company will not have taxable income in the rate year for state income tax purposes.
Okay, and that will be a read-in 7. Thank you.
Can I just ask a clarifying question, and that is, in light of the type of financial information being requested, would it be more beneficial for the authority if we provided that in a written supplement to the late file? I just wanted to probe if that's actually more helpful to Mr. Pfaff and Attorney Coker.
We were just discussing that, and we would prefer supplement.
Okay. And for witness Peruta and Murray, the request was if we can actually provide the information in a written supplement to late file 83, can the company accommodate that?
Yes, of course.
Thank you.
Okay, we will go forward with that. No longer go with the read-in. We'll do a supplement for late file 83. Thank you.
Yeah. Actually, I guess I have a follow-up question to that. And if necessary, this can be discussed in the supplement. But if the company is going to be at a taxable loss in the rate year, what is the cash that the company is incurring that is being sought recovery for through this cash working capital calculation?
We can explain that in the supplement, because again, I see what you're trying to get at. This only takes into consideration the current tax expense. We've excluded deferred tax expense because it's a non-cash item. The deferred tax portfolio is in rate base. So if you would please allow me to explain that more carefully, because it's a complicated breakdown. I think it will be helpful to have the opportunity to really list that all out, but I know what you're trying to ask, and I know how to answer. I just have to get all the data to support it for you.
Okay. And to put it in the most simple terms, I guess part of what I'd be looking for is, you report an expense of 10.5 million for the Connecticut corporate business tax. Is the company actually writing a check to the state for 10.5 million? And if it's not, what is the cash lag that the company is seeking to be compensated for?
So during the tax provision in the calendar year, rate year in this case, so in your rate year, the company will make tax payouts every quarter to state and federal. So those are our tax estimates that we do every quarter. When we perform our state tax return, that is ultimately when we have our return to provision adjustments, all of the work is performed and completed. If there's any difference between what was paid to federal and state, then that would be reflected in the final tax returns. So what we are expecting in the rate year is a taxable loss. And I will explain that in the supplement.
Okay. And I guess, not to belabor this point, but just to make sure that we get the information that we need, if you can describe specifically why the company is required to pay the 10.5 million, and if that's part of, if it's a requirement because of estimated tax purposes, even though the company is projecting a loss, then that can just be something that's described. But we would like to understand exactly what the obligation is on the company that is requiring it to pay this amount, even though it's projecting a tax loss for the year.
Yes, and to give you a high level subject to check, your lead lag study working capital has current. Your ADIT, which is your non-cash but is included in rate base, is going to have an offset there. So net, ultimately, what we include for cash working capital as an increase should have an equal and offsetting in your deferred. So net, you're going to have essentially representing what will be a zero tax liability. That's what I need to break down for you. That will be very complicated for me to do live.
Yeah. And I understand that net it could be a zero tax liability, but what I want to make sure that we're getting from you all is details regarding why, if it's zero tax liability or the company's coming in at a loss for state income tax purposes, it's still required to pay this 10.5 million. It still has $10.5 million of cash expenses that it's paying to state taxing authorities, even though it's projecting a loss and coming in at a loss.
The cash working capital in the rate base is representing just your current income tax expense. Your deferred income tax expense should offset that. So what I'm saying is what the lead lag study is focused on is just your cash items, which would include current tax expense. What we have done in the lead lag study is we have taken a non-cash approach. Had we had a cash approach, you would have your deferred taxes reflected in here as well, which would ultimately bring you to the rate year, which reflects a tax loss. So no cash impact. That's not reflected here because we are not performing a non-cash analysis. The deferred taxes, however, are represented in your rate base. Had we done that, we would have had to ensure we weren't picking it up in two places. Similar to prepaid, we did not include some of the prepaids in here. We included others. We made sure that if we included or excluded prepaids here, they were either included or excluded in your rate base application or rate base calculation, in order to ensure you weren't picking up two items and double counting. So again, going back to your original question of trying to determine how we have an amount in here that would show that there is a cash outflow, I need to also show you the equal and offsetting impact to your rate base, because your cash working capital is an amount that goes to rate base in order for us to get a return on it, correct? There's an equal and offsetting in your accumulated deferred taxes that I have to represent to you to show you that it negates it. So in its entire portfolio of rate base, it should be a net sum zero, but I don't have that breakdown for you. That I need to walk through that with the tax experts to make sure my theory works. Thank you.
Okay, so my next few questions are going to be related to attachment 2 to LFE 83. I'll give you guys a moment to open that.
I am there.
So it appears there may have been a miscommunication related to this LFE. This LFE, the prompt was intended to obtain a mapping of the amounts in the updated H-1.4 to the C schedules. The company instead appears to have calculated the difference between the filed H-1.4 schedules and mapped that to the C schedules. So using payroll as like an example, we're looking at looking for a mapping of the entire payroll expense to the relevant C schedule. What it appears the company did is provide a mapping to the C schedules is just the delta between the revised H-1.4 and the original H-1.4. We were looking for a mapping of the total amounts to the C schedules. Do you understand the difference that I'm pointing out?
Yes, and I'm sorry if we didn't understand your original question. So what you're looking for is in LFE 83 attachment 1, page 2. You're asking for the company to map out the expenses to the SFR schedules, correct, in column 6?
Yes.
Okay, we can do that. That's fairly simple. Thank you.
So my next question, the company used the rate year excluding rate increase for this mapping, but the cash working capital amount the company is requesting is based on rate year including the rate increase. Isn't that correct?
We'll include that in the supplement. The mapping will show you the amount where it's linked to in the SFRs.
Thank you.
You're welcome.
One moment.
And can we just confirm for the record, so that's late file 83, is that attachment 2? We've agreed to provide the supplement? Thank you.
That would be attachment 2. So let's go back briefly to schedule H 1.4. So row 31 on the schedule is labeled conservation, correct?
Correct.
Can you give me a quick summary of which expenses are considered conservation expenses on that schedule? Just like a general summary of what types of expenses you're talking about.
This is the energy efficiency. These are the energy efficiency costs that flow through our CAM rate.
And it's just that expense.
It's just that expense, and it's included in the lead lag study. Because, hold on one second. I'm so sorry. I thought Mr. Murray wanted to confer. Yes, this is the energy efficiency costs.
So now please refer to schedule C-311.
Yep, we're there.
So near the bottom on lines 39 through 41, it says conservation expenses are recoverable through the conservation adjustment mechanism. These costs are part of conservation plans that are approved by DEEP. If these expenses are recoverable through the conservation adjustment mechanism, why is the company including these costs in its cash working capital calculation?
That's a great question. Thank you for that. So the expenses themselves are recovered through the conservation adjustment mechanism, which is why on this schedule, you'll see that we've removed completely from this cost of service base distribution rates, all those expenses. The cash working capital component is not a part of the conservation adjustment mechanism. So there is no cash working component, a rate base similar to what we have here. So the cash working capital component is recovered through base distribution rates on these expenses, but not the expenses themselves.
Thank you. When you recover expenses through the conservation adjustment mechanism, are the charges used to recover the expenses calculated based on billed revenues for the period or accrued revenues for the period?
Can we do a read-in to confirm that?
Sure.
Mark that read in 8.
7, actually.
Oh, back to,
Read in 7, correct,
Oh, yeah,
Commissioner,
we're back
because
to-
that's right, we canceled
we
that one.
turned 7 into a
Yes.
supplement.
Thank you.
Read in 7, thanks.
And I just wanted to confirm that the company's planning to provide a supplement to LFE 83 attachment 2, and that was the mapping of the updated H-1.4 to the SFR schedules.
Understood.
Okay, and just in an abundance of caution, what we're looking for there is to take an example, page 2 of LFE 83, attachment 1, the supplemental response. The very first item there is payroll at 49.030 million. What we're looking for is a mapping of that amount to the applicable SFR schedule, which I assume is probably going to generally be C schedules, but maybe not always. And then to the extent that they don't match up exactly, and an explanation of and quantification of any reconciling items.
Yep, we could definitely do that.
Thank you.
Okay, one moment, please. That's all I have for this panel.
Thank you to authority staff. I think that concludes authority staff questions for this panels. Thank you very much. Next, we have OCC.
Morning, Tom Wheel for the Office of Consumer Counsel. I wanted to start with just some follow-up from this morning. Did I hear that the 203 million deficiency in late file 1 is not accurate anymore?
It's still late file 1, but we filed a supplement 2, which at the end of that file name was labeled revision 3.
Okay. And is that the 174 million, Ms. Peruta, that I haven't seen that supplement. Can you just read out the most current revenue deficiency on that?
Sure. So it's 193,134,000.
Okay, thank you.
And I would just clarify, that is comparable to the 174. There's additional taxes on top of that would get you to the 193. But as part of our late file 1, supplement 2, revision 3, you'll see both numbers in Schedule A 1.0.
Gotcha. Okay, so Ms. Peruta, when you mentioned 174 before, that was like the pre-tax adjustment revenue deficiency? Okay, gotcha.
Well, just to clarify again, it was pre-GET and uncollectibles.
Yep, okay. Thank you. I think actually my only questions are about late file 61, attachment 1. If you can let me know when you got that open.
Yes, we're there. Thank you.
Sure. So I stared at this with my dumb attorney brain for a long time and tried to figure out how it all works. Could you just, what I am most interested in and couldn't really determine is how column M is calculated. So I see like the allowed, I understand I see the allowed rates of return on equity for each of the subsidiaries, but my understanding is that there's some allocation of that derives the weighted ROE per subsidiary in column M, but I'm not getting like the math of how that works.
Okay, so apologies, Attorney Wheel. I was pulling it up, the Excel workbook. I had the PDF, so I just want to, now I have the Excel workbook. So you're looking at column M.
Yeah, and it's the labeled column M. I'm actually also in the PDF, so I'm not sure if I don't know if that's the Excel column label. But yeah, I'm asking about the weighted ROE calculation, I understand that the total of 9.62, I understand is just the sum of all the numbers above it, but the numbers above it are what I'm trying to figure out how you get there.
Yes, what concur.
All right, so thank you for that. So just to be clear, this is how the service company actually charges down to the operating companies. But as part of this proceeding, the company will update for the authorized ROE that's ultimately authorized in this proceeding. So with that being said, I'll walk you through the math. So essentially what it's doing, and I'll try to keep it pretty simple.
Please.
So from left to right, there's individual rate codes that are used for different subsets of capital at the service company. And for each of those subsets, there's a weighting between the operating companies in each column. So Each column sums to 100%. And going across, each ROE has a weighting based on those rate codes. So starting with just the first 9.25%, for example, for M9C in column E, it's weighted at 20.54%. So that's the first step. The second step is saying M9C represents about 52.56% of the total capital at the service company. So that 9.25% weighted for 20.54% gets weighted 52.56% in total. Similarly, for the next rate code, B05, 9.25% gets weighted at 39.08% for that rate code, but the capital that utilizes that rate code is 9.29%, so it gets weighted again. And so on and so forth going across the columns, and then same with each of the authorized ROEs that are listed in column N.
Okay. And how do you start, is column A, the M9C, like how do you get, so for CLMP distribution line 1, which I know is not in this, has nothing to do with Yankee except for the purposes of this calculation. I'm just using it because it's the first line, so it's the easiest one to look at. That 20.02, like what drives that? That's the allocation that ends up in the total of 97.49 in that first. Sorry, I'm looking at the labeled column A, not the Excel column A.
You're asking specifically how was M9C calculated?
Yeah, I mean, and for any, again, it doesn't matter whether it's CLMP distribution or Yankee, or I just don't know, like, where does that number come from? Like, what drives?
Yeah, so each rate code is derived differently. So I believe in the company's response to RRU 023, we provided the calculations, the detailed calculations of each rate code. Just if you give me 1 minute, I'm going to pull up the attachment, and I can refer to M9C specifically.
Okay, you said RRU 023?
Yes, I'm just double checking that reference now.
Attachment 3, maybe. I have it printed. Oh, let's go RU 23.
Yeah, so RRU 023 attachment 2 provides all the company's rate codes, and it has a tab in the Excel file for each rate code and how they're calculated. So in reference, just for one example, for M9C, that was based on service company budgeted labor, and that allocates out to companies 11, 1T, 21, 06. I can give you the names, but it's the listing of all those companies. So distribution, CLMP, transmission, CLMP, NSTAR Electric. And it's based on budgeted labor, and all those labor amounts and allocation percentages are listed in that attachment.
Okay. Thank you. I don't have any specific questions about the attachment, but it's helpful to, I just wanted to sort of conceptually understand how you landed those numbers. Thank you. I just have a couple more questions about the late file. What is again, this is probably like an overly basic question, but what in line labeled 25, the plant balance, what's the significance of the plant balance as opposed to, I'm familiar with generally like the concept of calculating the rate of return on equity and the like cash value of that in relation to rate base, but as we know, like plant is just a component of, is the plant balance the only rate base for ESCO purposes? Is that why it's labeled that way?
Let's take a step back. This calculation is trying to determine how much of ESCO's plant assets are being utilized across the operating companies. So when the plan accounting organization works with the functional areas to determine like, okay, you constructed an asset or you had IT upgrades, who's using that?
Yep.
Through that process, they determine cost causation. Once the plan accounting team knows that plan asset is going to be used by Yankee Gas and Star Gas EGMA, then that cost causation leads to the rate code. So you'll see at the bottom, the plant balance is just driving your weighing of, and let's focus on Yankee Gas, how much of Yankee Gas related plan assets at ESCO is Yankee Gas using? And then for those plan assets, within the weighing calculation of the return for ESCO, applies to the Yankee Gas 9.25% allowed return. And we determine that by looking back into the plan accounting books to say which of the assets are being used by Yankee Gas and the proportionate share. And then that's weighted in order to take the Yankee Gas's allowed return of 9.25%, as Mr. Murray walked you through, to weigh it in the total ESCO calculated allowed rate of return. So the underlying data is related to utilization across the regulated operating companies, and then their proportionate share of utilization is then used to weigh their allowed return, which then builds your total return on a weighted average basis for ESCO.
Okay. So it's not that ESCO doesn't have like liabilities on its balance sheet, but it's just that the plant is the only thing that's it's the assets being utilized by the operating companies, right? Like that's the idea.
Correct, because this sheet is what ESCO uses to build an appropriate return as the underlying return for ESCO to charge across all its operating companies. So very separate and distinct. But keep in mind where you're pointing back to is the capitalization funding expense that's ultimately allocated down.
Yes.
Remember, the company's going to ultimately use within this rate case decision what was allowed by PURA.
Yeah. Yep.
So this whole model gets tossed.
That I understand. I guess the nature of my question was, it's my understanding that like, so this is using the first calculation here, because I also acknowledging there are 3 different models here, but using just for example, the 9.62% here, it's my understanding that that is like the functional rate of return on equity for ESCO. And then that ultimately derives an overall revenue requirement. But that's, as I understand it, that's just a component of the overall rate of return, which is what drives the revenue requirement, right?
That's correct.
Okay. So that's what I was asking. That's why I was thrown by like, why are we only talking about plants? But I think I understand. The plant is just used to figure out the rate of return on equity, because the rate of return on equity is based on the allocations of usage of the assets. But then at the end of the day, that 9.62 is still part of it's just a component in the overall rate of return calculation that derives the revenue requirement that's then allocated. Is that
Correct. That plan is only used to just allocate and to assign those ROEs and weight them. It's not, yeah, correct. Everything you said is absolutely correct.
Okay. Got it. That's our last question for this panel. Thank you.
Thank you.
Thanks, OCC. EOE. Thanks. Attorney General. Commissioner Carey?
No questions.
Okay. I also do not have any questions for this panel. So thank you.
Commissioner, can I please have permission just to consult with the witnesses for
yeah.
5 minutes for?
I'm sorry.
record?
Yeah. Attorney
Thank you.
Pace,
Thank you very
would you
much.
like?
Yes, please, just 5 minutes.
We'll do a
please.
5-minute recess.
Very
Thank you.
much. So thank you, commissioners, for the chance to consult with my witness panel. And just to refresh everyone's recollection, this panel testified yesterday afternoon as well as this morning. And my questions for redirect examination go back to the testimony they provided yesterday. So starting first with Ms. Peruta. Ms. Peruta, do you recall the questions you received yesterday from Attorney Keenan and Mr. Bakari relating to valuation allowance? Do you recall that exchange?
I do.
Can you provide additional information in response to the questions you received from Attorney Keenan and Mr. Bakari on valuation allowance?
Yes, I just wanted to make it clear for the record and emphasize that the fixed capital credit, as I stated, is fully reserved through the FIN 48 reserve. And that's as a result of previous state tax audits. Because we are fully reserved using the FIN 48 UTP reserve, there is no need for an additional reserve through valuation allowance. So it is zero valuation allowance.
Okay, thank you. My next question on redirect examination is directed to Ms. Day. Ms. Day, do you recall the questions you received yesterday from authority staff regarding late file 73 that referred to control rooms and the associated expense for the gas business? Do you recall that exchange?
Yes, I do.
Do you have any supplemental information you can provide in response to the questions you received yesterday about the need for the new control room?
Yes, thank you. So I just want to make sure that everyone understands that our control rooms are critically important for the safety of our system. So when we're performing work on the system, our control room operators are monitoring everything that's happening on the system, all of the different projects happening at the same time, 24 hours a day, 7 days a week. And we are required to maintain control room management policies, which are kind of similar to like air traffic controllers. This is mandated by PHMSA, and PHMSA actually references in their description of those regulations that they provide significant public benefit. That's their own words, because of how important it is that we have that oversight of all of the work going on our system and that we have sufficient operators who have their fatigue managed such that they can maintain the mental acuity required to oversee all of that work, even if some abnormal operating conditions come up. And so all of the benefits of the consolidated control room improve that human machine interface for our control room operators. It allows us to have more staffing at all times. And in the event of an incident, it means that for Yankee, you would be able to have additional operators immediately available to manage that incident because it's consolidated across our different operating companies.
And Ms. Day, do you recall you also received questions yesterday on what is the need for actually having a backup control rooms? So can you explain in terms of contingency planning why it's important to have that type of setup for a gas distribution company?
Yes, thank you. So it goes back to the same idea of how critically important it is that we maintain this oversight over all of our work and our system and how it's operating at all times. So to be clear, we've always had backup control rooms at Yankee. Now we have backup control rooms for the consolidated system. And it's very important that no matter what happens, I think we saw with COVID very directly, right, the need for why you need to have these different facilities available. We have to make sure that no matter what is going on, there is a place where our operators can oversee and maintain the system for the safety of, the public and Connecticut. Thank you. And I don't know if my colleagues have anything else they want to add.
Nothing to add.
Okay, thank you very much. That concludes my redirect examination for this panel. Commissioners, I wanted to move to two administrative matters, if I have your permission to do that. During the very short recess that we had, I asked our witness panel, do they have the answer to read-in number 7? And that's where the company received a question regarding the conservation adjustment mechanism in terms of billed versus unbilled. And I believe Mr. Shelnitz does have the answer, if he can have permission to provide that into the record. Thank you very much. Mr. Shelnitz, you can proceed to give the answer.
Yes, we were able to confirm that the conservation adjustment mechanism is based on billed revenues only.
Thank you. And the second administrative matter I'd like to, with the authority's permission, re-raise, since we've just completed this panel, is that at the outset of this morning's hearing, I raised the administrative issue of can we promote efficiency by having the next panels be PBR on page 16, followed by environmental on page 13, followed by rates on page 8. And the reason why I made that request was looking at the current schedule, no party has reserved any cross-examination for those panels. And unless there's an objection by a party who's here today, we think that for administrative efficiency, if it's so amenable to the commissioners, we could have those panels come forward, they can adopt their late file exhibits, and if in fact no one has any cross-examination with the authority's permission, we can release those witness panels. So I know counsel for other parties did not have a chance to respond to that, and I'll defer to the commissioners in terms of how you want to elicit their feedback to that proposal.
Thank you, Attorney Pace. Let's start in order, and I will call out the panels that you've referenced. If a party or intervener who's present today would like to object or note that they have cross-examination for the panel, that would be helpful. So does any party or intervener have and I'm going to say extend the question to authority staff and commissioners. Does any party or intervener have any questions for the PBR panel on page 16? Does any party or intervener have any questions for the panel environmental site investigation and environmental remediation on page 13? Seeing none. Does any party or intervener have any questions for the company's rate design panel on page 8? Thank you. Then let's do this. Let's take panel on page 16 and panel on page 13, and we'll go ahead and adopt those. Looking at the panel, who is the most overlap here? So you want to do PBR right now?
Yes, please, if we could. Thank you, commissioners, for that. So if we could please have our PBR panel come forward.
Attorney Tisler, please.
Thank you. For the PBR and metrics panel, we have witnesses who were all previously sworn. Good morning to the panel. Would each of you please state your full names and positions for the record, starting with Mr. Kruger?
Seth Kruger, Vice President, Gas Engineering, Eversource Energy Service Company.
Julia Day, Director of Gas System Engineering, Eversource Energy Service Company.
Doug Horton, Vice President of Distribution Rates and Regulatory Requirements for Eversource Energy Service Company.
Maggie Cousino, Director, Gas Meter Services for Eversource Energy Company.
Jared Lawrence, Senior Vice President of Customer Operations and Digital Strategy and Chief Customer Officer for Eversource Energy Service Company.
To the panel, as part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the evidentiary hearings in this case?
Yes.
And do you have any corrections or clarifications to any of your late filed exhibit responses not previously identified?
No.
And do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
Okay, thank you. The panel is available for cross-examination if there is any.
Thank you. And having previously solicited the parties and interveners, I will do one last check with the commissioners. We will waive cross, so I guess there's no redirect. So this panel is excused. Thank you. Let's move into the panel on page 13, please.
So if we could have the environmental panel members for Yankee Gas, please approach.
For the environmental panel, we have Gary Iadarola, who was previously sworn. Mr. Iadarola, can you please state your full name and position for the record?
Gary Iadarola. I'm the manager of the environmental remediation team at Eversource.
As part of your preparation for this late filed exhibits hearing, did you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of the evidentiary hearing in this case?
Yes.
And do you have any corrections or clarifications to any of your late filed exhibit responses not previously identified?
No.
And do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
Thank you. The witness is available.
Thank you. Having previously solicited cross and seeing none, this panel is excused. Thank you.
Thank you.
Thank you.
Okay, so I guess that brings us to the rates and rate design panel on page 8. So it sounds like OCC does have cross for this panel, so I'll invite them to approach along with the company's witnesses, please. Okay. Attorney Tisler, please.
Thank you. For this panel, all of the members of the panel were previously sworn. Good morning to the panel. Would each of you please state your full names and positions for the record, starting with Mr. Therian?
Morning, Greg Therian, Vice President, Concentric Energy Advisors.
Good morning, Kimberly Parsons, Senior Analyst, Connecticut Rates, Eversource Energy Service Company.
Morning, Garrett Murray, Manager Revenue Requirements in Connecticut for Eversource Energy Services Company.
Good morning, Marissa Pruda, Director of Revenue Requirements for Connecticut and working for Eversource Energy Services Company.
Michael Schelnitz, Manager, Revenue Requirements, employed by Eversource Energy Service Company.
The panel, as part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
Yes.
Yes.
And do you have any corrections or clarifications to any of your late filed exhibit responses not previously identified?
No.
No.
Do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
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 Thank you. The panel is available for cross-examination.
Thank you. We will begin cross for this panel by the OCC, please. Attorney Wheel.
Good morning, Tom Wheel for the OCC. My first questions are about late file 94. I don't know that you even need to open it, but I can give you a second.
I have that.
So we saw the explanation for how the company wasn't able to provide the manual, and we did appreciate that we got copies, but the original late file request also asked for the relevant pages from the manual that were used to derive the overall rate design results. Were you able to identify those pages?
Pages 22 to 25.
Okay. And as a follow-up, did you identify any guidelines from the manual regarding aggregating data or performing the regression or how to interpret regression outputs?
No, my recollection upon reading it was that it was a pretty high level analysis and discussion of customer costs as a part of the allocation of mains.
Okay. Thank you. My next questions are about late file 96.
I have that.
The intercept values in these interpretations were directly used to calculate the customer classification percentages. Is that right?
Yes, as well as the results from late file 89. Yes.
Okay. I had some questions about this. It says in this late file in the summary section, it says the intercept's p-value and the 95% confidence intervals indicate that the predictor does not have a statistically significant effect on unit cost. Therefore, the intercept does not significantly contribute to predicting the outcome variable unit costs. Were you able to produce any interpretations about the validity of the intercept values themselves?
So there's in a regression, a simple regression like this, there's two considerations: the intercept and then the which is the results that we were discussing here in late file 96, and then the diameter, which is the results from late file 89. The relationship that we were looking for in this regression analysis was diameter, which was statistically significant. The intercept is not significant, but that's not really the relationship that we're looking for in this particular analysis. So no, to your direct question, the answer is no. For the intercept, there was no correlation.
Okay. But with the understanding of the view that it's not statistically significant, was there any interpretation of the validity of the values? Like was there an interpretation of whether the values themselves were valid?
Well, you're seeking a value of 0, so no.
Okay. You mentioned the diameter of mains being one of the inputs. What's the rationale for framing the interpretation of the intercept as the predictor's effect on unit costs? Is the intercept a second predictor based on that statement, or is the only predictor the the main diameter?
The only predictor is the main diameter.
Okay. The intercept is just the expected output of the model when the predictor variables equal 0, I think, as you just said, correct?
That's correct.
Okay. So the intercept, as I think you just confirmed, doesn't have any effect on unit costs?
For this regression, that's correct.
Okay. During the hearings, when a much smarter OCC person asked you whether the 95% confidence intervals in the intercept meant that 95% confidence was the actual value of the intercept, my recollection is that the panel had testified that it hadn't analyzed that data. Is that correct? I can ask the question again.
Well, let me try to answer it in the context of our review during the late file to help, because
my next question was going to be, has there been any subsequent analysis during the late file?
Well, we did in late file 89 in the context of the diameter, and our findings are that the confidence intervals were fairly narrow, and that our results fell between that narrow band, and that the results are favorable.
Okay.
Supportive of again, back to what we consider to be the most important statistical result in this analysis, which is the R squared and adjusted R squared.
Okay. Were you able to evaluate any level of confidence? I guess is a similar question than I asked before, but it sounds like the evaluation was specific to the diameter, the pipe diameter. Was there any reevaluation of the intercept?
Only in the context of answering the question to late file 96.
Okay.
Again, the primary response is diameter.
Thanks. Just 1 second. Okay. I think that is one last question, actually, just to be sure I understand, because I'd asked you before about the intercept being a predictor, and you mentioned that in this regression it's not, right?
It's not a predictor, it's the end result of the regression of the diameter, the cost per foot of the diameters.
Okay. So in the summary statement where it says the intercept's p-value and the 95% confidence intervals indicate that the predictor does not have a statistically significant effect on unit cost, what predictor are you referencing there?
Well, basically, we're answering the question about what was asked, which is about the intercept in late file 96, which is, does the intercept matter in the regression equation? The answer is no. What you really need to look at is the diameter equation, the diameter results from late file 89. That's what you should look at. And those are statistically significant.
Okay. That's our last question for this panel. Thank you.
Thank you.
Thank you. Authority staff. EOE. Attorney General. Thank you. Commissioner Carey.
No questions.
I also didn't have any questions. Does the company need a moment to consider redirect?
Just a very brief moment, since it was very limited cross-examination.
Please, we'll stand at ease.
Thank you. Thank you for the chance to confer with the witness panel. I have no redirect examination for this panel.
Thank you. We'll move into the company's capital planning and additions panel listed on page 10. Authority staff will be up first to cross-examine, please. If I could ask the witnesses to approach. Okay, Attorney Tisler, please.
Thank you. I just want to make a few comments about the capital additions panel here. Unfortunately, Mr. DeRozier is not able to join us today due to a death in his family. So the company is adding new witnesses, Mr. Christopher Ellert and Miss Leanne Landry, to cover his materials. They will need to be sworn in today. Additionally, just to note some additions or changes since the prior evidentiary hearings for this panel. We also have members of the Revenue Requirements Team, Marissa Pruda, Garrett Murray, Michael Shelnitz. We also have Mr. Brendan O'Brien, Seth Kruger, Michael Dorval, and Eric Soderman joining this panel, and those members were previously sworn.
Yeah.
So, good morning to the panel. Would each of you please state your full name and position for the record, starting with Mr. Kruger?
Good morning. Seth Kruger, Vice President, Gas Engineering, Eversource Energy Service Company.
Julia Day, Director, Gas System Engineering, Eversource Energy Service Company.
Brendan O'Brien, Director of Revenue and Regulatory Accounting for Eversource Energy Service Company.
Good morning. My name is Leanne Landry, Director of Investment Planning for Eversource Energy Service Company.
Good morning. Christopher Ellert, Manager of Gas Capital Compliance, Eversource Energy Services Company.
Good morning, Garrett Murray, Manager, Revenue Requirements for Connecticut, Eversource Energy Services Company.
Morning, Michael Shelnitz, Manager, Revenue Requirements for Connecticut, employed by Eversource Energy Service Company.
Good morning, Marissa Pruda, Director of Revenue Requirements in the state of Connecticut, employed by Eversource Energy Service Company.
Eric Good morning, Eric Soderman, Director of Gas Supply, Eversource Energy Services Company.
morning. Michael Dorbel, Director of Real Estate and Property Management, Eversource Energy Services Company.
Thank you. Could we please have Mr. Eller and Ms. Landry sworn in?
Yes, if the two witnesses could please raise your right hand, I'll administer the oath, at the conclusion of which please affirm by stating I do. I swear to tell the truth, the whole truth, and nothing but the truth under pains and penalties of perjury.
I do.
Thank you.
Mr. Eller and Ms. Landry, have you reviewed Mr. DeRozier's late filed exhibits for this case and his supplemental interrogatory response ENG-001-SB05?
Yes.
Yes. And for purposes of admission to the record, do you adopt those materials as your own?
Yes.
Yes. To the remainder of the panel, as part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
Yes.
And to the panel, do any of you have any corrections or clarifications to any of the late filed exhibit responses not previously identified? No.
Attorney Tisler, I do. So for late file 124, excuse me, regarding project CTG SVH22, in our response, we incorrectly stated that the specific work order was not in service, which why part of the additions were higher than the, higher than the actual cost, but in fact, the work order is in service. It was for salvage as stated in the response, and it's associated with old vehicles. These credits were accounted for in our 108 account and not within additions. So the total project cost includes the salvage credits going to 108, which is why the total project costs are less than the additions.
Thank you. To the panel, do you adopt your late filed exhibit responses and supplemental interrogatory responses as part of your sworn testimony in this case?
Yes.
Yes. The panel is available for cross-examination.
Thank you. We'll begin cross-examination of this panel by authority staff. Attorney Coker, please.
Good morning. I'm here as Staff Attorney Josh Coker. Please open RRU 100, the response to RRU 100, including its attachment, and the response to LFE 110. Let me know when you have those documents available.
For 100, is there a specific attachment? I think there may have been multiple for that one.
Just have them handy. They'll be good.
Sure. Go ahead. I'm ready.
Okay, so in subpart B of RRU 100, the company was asked to provide sample journal entries related to the accounting and rate-making treatment for negative net salvage when replacement mains and/or services are installed. The sample journal entries were provided in attachment 1 to RRU 100, correct?
Can you repeat the question? I guess I'm struggling with the term journal entry. I think that the attachments that we're presenting and you said 100 attachment 1?
Yes.
So 100 attachment 1, I think LFE 100 related to questions regarding the presentation of the depreciation rates that were included within the company's FERC Form 2. And so there was some questions around.
May be able to provide some clarity. We're talking about RRU 100, not the LFE.
Oh, I'm sorry. Okay, sorry. I see the journal entries now that you're referencing.
Thank you. Please look at journal entries 3 and 4 and attachment 1. Journal entry 3 provides an example of crediting to account 108030 after the work order is closed, correct?
Could you just give me the reference again? Sorry, I just got to pull up RRU 100.
Okay, sure. This would be attached. So the response is attachment 1 that we're looking at. That has the journal entries. So RRU attachment 1.
And it's RRU 100 attachment 1, correct?
Yes.
Okay, sorry.
No problem.
So when you're referencing journal entry number 3 and 4, okay, I'm sorry. It's designated by the numbers. I'm following you. Sorry.
So I'll repeat the question. Journal entry 3 provides an example of crediting to account 108030 after the work order is closed, correct?
I think what that's indicating where it says work order closed to account 101 is just indicating that from an in-service perspective, specific to that work order is moving to a fully functionalized and unitized asset. So I think what that's referring to is likely that a work order that was originally included within FERC account 106, which is cost completed, not classified, is moving to 101. So that's how I would describe your question of where the work order is closed. It's more specific to the in-service part of that work order than it is to, I think, the removal aspect, if that makes sense.
Just to be 100% clear, when you're saying that, when you're talking about the two, what is being closed in journal entry 3?
It closed is probably not the correct term. I think what we're doing here and what's included within the FERC uniform system of accounts, there's multiple, as we outlined extensively within LFE 110, there's multiple FERC accounts that are included in there. I think it goes from 101 to 114, I think, off the top of my head, for gross utility and service plant. So all we're talking about here is that when a work order is completed and is moved from QIP to in-service, the original account that is typically used is FERC account 106. And then there's a process to fully unitize that asset, and it goes from FERC account 106 to 101. So it's simply that what's referenced there where we say work order is closed. I think all we're saying is by closed, we're saying it's moved from FERC account 106 to 101 from a presentational perspective under the FERC uniform system of accounts. And it's important to note that both of those, all of those in-service accounts that are used, whenever an asset's placed in service from a depreciation perspective, all of those assets would begin depreciating.
Could you read to me what journal entry 4 states under the attachment 1 to RRU 100?
So what journal entry 4 here is representing is under the uniform system of accounts and under the FERC US of A rules and accounting rules, whenever an asset is retired, what's required to be recorded is that you would credit the in-service utility plant as that asset is no longer in service. And you would debit that to the accumulated depreciation. And from an accounting perspective, the reason that journal entry is performed is because when you think through an asset that may have been in service for, I think in some of the LFEs, we saw assets that were retired that were even a century old. And so all of those assets at that point in time would have been fully depreciated. So when you think about the FERC uniform system of accounts, you have your gross utility plant, which as we outlined in LFE 110 is FERC accounts 101 through 114. And then you also have in there accumulated depreciation. which is FERC accounts 108 through 111. And so when you think about an asset that may be, say, 100 years old, like we had in some of these LFEs, some examples of those retirements, you would have, in this example, an original asset of $800. And throughout that asset's life, you would accumulate $800 in accumulated depreciation. And simply what this journal entry is representing is that when you retire that asset, you are simply taking the gross plant value in account 101 and debiting that to FERC account 108. And inherently what that's doing in the accounting books and records is just showing that asset is no longer on the books. But the net entry there, and it's important to note, is no impact to net utility plant.
One moment, please.
And just one other thing, like I mentioned, I think I said this at the beginning, but just to make sure the record's clear, that process, and we outlined this in LFE 110, I think, where we gave an example of the FERC requirements for retirements and how that works. That's required under the FERC Uniform System of Accounts and the accounting guidance there, and is also under GAAP as well.
So this is, you partially answered this question, but I'm going to ask it anyway. Journal entry 4 states that the old asset is removed and shows a debit to account 108010 and a credit to account 101010, correct?
That's correct. As I just described, under the FERC Uniform System of Accounts, when an asset is retired, it's required to be debited to FERC account 108 accumulated depreciation, and it would be credited to the gross utility plant.
Thank you. Now please turn to page 8 of the response to LFE 110. Let me know when you're ready.
You said page 8?
Yep, page 8.
Yep, I'm there.
So the narrative answer here reports that approximately 11 million of cost removal expenditures in account 108030 are not yet associated with completed asset retirement, correct?
Yeah, so just to take a step back, I think, what the company endeavored to do in response 110 here is there was, in the evidentiary hearings, there was quite a bit of discussion about cost of removal, retirement, salvage value, and all of those are really individual and distinct things. So what we endeavored to do here in response to LFE 110 is to try to provide a robust answer to really highlight not only the accounting, but the rate-making impacts of these values and how they work, why the FERC has set up the uniform system of accounts, and go through each of them extensively. And the paragraphs you're referencing here are to answer the question, which was, of the amounts included within account 108030, which assets do not yet have an associated retirement? And we tried to present that, for multiple different periods, which have been discussed within the proceeding. So what the company identified in our analysis is that the majority of that value has an associated completed retirement. There's also an additional, of the amounts that did not yet have a retirement, there's a component that is the new construction related to that work is in service and completed. And then there's an additional amount that does not yet have a retirement date associated with it and is not in an in-service or completed state. And just to circle back to the question that was asked at the evidentiary hearing, where we talked about why cost of removal expenditures are included within FERC account 108 and why they're included within in-service immediately, the distinction there is really due to the fact that when you're talking cost of removal, the dollars that are incurred there specifically relate to the retirement or the removal of assets that have been in service. And to just highlight what's evidenced in LFE 103 to 107, the in-service dates for those retired assets are decades to a century old. And under the depreciation rules and under a depreciation study through the negative net salvage value that's established in depreciation rates, the negative net salvage value is designed to be concurrently, if estimated appropriately, to be concurrently recovering from customers the cost of removal, projected cost of removal expenses for those assets. And the reason for that is because it's important to prevent generational inequity that the customers through depreciation expense are not only paying for the assets that are in service, but they're also paying for the expected future removal costs of those assets so that the customers of tomorrow don't pay for the costs or the benefits that the customers of today have received. So, to circle back to your question, yes, we identified for the period evaluated March 31st, 2025, that there was approximately $11 million of the $171 million included within account 108030 that did not have an associated retirement date yet. But it's important to highlight that the differentiation and the reason that cost of removal is included within FERC account 108 under the FERC US of A is because those costs relate to assets that were previously in service, were previously determined to be used and useful, and likely have, if negative net salvage has been properly set, would be designed to now represent the incurred costs that would have been collected from customers over time. So sorry for the long-winded answer, but I just think it's important to provide context. That's why typically all cost of removal is included within FERC account 108, which is included within the cost of service.
Thank you. If we define an asset that is not yet retired as one for which journal entry 4 would not yet have been recorded, how would that definition differ from the one that you used to arrive at the $11 million figure in LFE 110?
Could you repeat that question? Sorry.
Sure. If we define an asset that is not yet retired, that's the term we're defining, as one for which journal entry 4 in RRU 100 has not yet been recorded, how would that definition of asset that is not yet retired differ from the one you used to arrive at the 11 million figure in LFE 110?
So the difference there would be that within 110, as we highlighted in the response, there's an amount of cost of removal that's incurred that does not have a retirement associated with it to date. But it is completely the project or the work order is in an in-service status. And so what that really means is that the part of the job that's related to new construction in the new assets are in service. They're in accounts 101 through 114, which I described under the FERC Uniform System of Accounts. Those assets are depreciating, and the accounting process to finalize the retirement is in motion. And so that date there, it doesn't have a date that it's yet been retired. But again, to just take a step back, really all that is from an accounting perspective is both of those amounts, the 108030, the cost of removal that are incurred in there, as well as the in-service amounts that are included within FERC accounts 101 through 114 are both they're both in the cost of service. It's just a classification between the two. And just circling back to my previous answer, the reason that the cost of removal costs are included within FERC account 108 is because those costs that are incurred, whether there's a retirement date associated with it yet or not, is related to previous assets. And as is outlined in LFE 103 to 107, those assets are decades old typically. And those were previous assets that are used and useful, provided service to our customers, and through the negative net salvage value recovered through depreciation expense. Those costs, if negative net salvage was set appropriately, should have been concurrently recovered over time throughout that period.
One moment. How would the 11 million figure in LFE 110 change using the definition you just provided?
How so? Can you clarify that?
How would the definition of the one, you had an 11 million figure in LFE 110.
For the amount that is not in an in-service status or does not have a retirement date, correct?
How would that change?
If what occurred?
This is Ryan Papp, consultant with Pure Staff. So in LFE 100, we talked about the journal entries, correct? And we talked about how journal entry number 4 was the journal entry to remove from the books the book cost of the retired asset.
The original, yes.
The original retired asset. How would the $11 million figure change if we included all of the assets that had not been retired, using that as the definition?
Meaning that the original book cost hadn't been included?
Yes, that.
So basically, looking at LFE 110, attachment 1, looking at the listing, you'd be looking for the amount that does not have an associated retirement date?
I would be looking at, and I just want to be precise here, so
sure,
talking the same language. I would be looking for any of the cost of removal amounts that were associated with an asset that had not yet been, quote unquote, removed from the books with journal entry number 4. Does that make sense?
Could we just pause there just to make sure, does the witness understand what he's being asked to compare?
I think so.
Okay.
I think I do. So I think, and we highlighted this in the response, I think it would be the inclusion of both the $11 million that's highlighted as well as the 19 million from a cost of removal perspective. But just to circle back to my previous point, the reason cost of removal is included within FERC account 108, and the reason that it is included within the cost of service in full is because it relates to the retirement costs incurred for assets that were previously identified as used and useful assets that are fully depreciated. So I know we've gone through the exercise to parse out the data and to show it that way, but it's just important to highlight that the cost of removal, the $171 million that's shown for March 31st, included within FERC account 108030, all of those costs are related to the removal associated with assets that were previously in service and being recovered from customers. And if done appropriately through a depreciation study, and the net salvage value was set perfectly, which just hearing Mr. Alice talk about the depreciation studies is a very difficult task to be able to do that. But those costs would have been, those cost of removal dollars that are now being spent and reflected on the company's books would have been recovered through accumulated depreciation and depreciation expense over the duration of time.
And I just want to add, I know that sometimes I think when we're talking about these accounting terms, it can be hard to really conceptualize what's really happening. But that work that we do for cost of removal, which for us is usually more like the cost of retiring the old asset, is real work that's critical for public safety, for the safety of people who, might perform future excavations. We have to perform work in order to purge the gas from those assets in a safe manner so that when we abandon them in place, they no longer pose a risk to the public. And so that work is very important and is a critical part of all of the work that we do.
I've got a follow-up question related to the balance that you stated for 108, 108030, the 171 million.
Yes.
Okay, if we look at the journal entries, well, first of all, would that be a debit balance or a credit balance?
So if we're going back to the journal entries, are you thinking about journal entry 4 that you referenced? So it's important to note journal entry 4 is not what's represented in account 108030. What's represented in account 030, hold on, give me a second. I don't know. Let me just see if that journal entry is in RU 100. Yeah, so So what's represented in account 030, just to put into perspective the debits and credits as well. So accumulated depreciation for accounts 108 to 111 is typically a credit balance. The gross utility plant would be the debit balance. It's negated over the accumulated depreciation reserve that accumulates over time. The cost of removal that's incurred is a debit balance that's recorded to 108030. And that's as the operations folks to my right here and their teams go out into the field, and they actually go through and they dig to find the pipe, replace the pipe, go through all the necessary and vital safety functions that we need to do to be able to safely retire those aged assets. That represents the costs that are incurred today to retire those assets. So that journal entry is separate and distinct from the retirement of an old asset. So I just want to make sure that's clear. And when you referenced your question, like the amount of retirement that relates to journal entry 4, that's not included in the attachment to LFE 110. What's included within the attachment to LFE 110 is the cumulative cost of removal balance that's been incurred from a spend perspective to retire those assets. But that's different than the journal entry you're referencing in journal entry 4, which is simply retiring those the old assets from an accounting perspective and taking the original book cost, which at this point, from a net book value perspective, is likely zero.
I understand.
Okay.
Yeah. And I apologize. I misspoke before. I was referring back to these journal entries, but not specifically to journal entry 4. And I'll tell you specifically what I'm curious about. If we look at the balances that are broken out on the left side of RU 100. And we can see that cost of removal, which is the second to last account listed, has both a debit and a credit balance, debit and a credit entry of 600. Do you see that?
I do see that.
So if that occurred for all of the cost of removal projects that the company had, and let's say that for a hypothetical, they were all completed, that balance would be zero, right? Because there'd be an offsetting debit and credit.
So I think what you're getting at is the vital nature and the importance of a depreciation study, right? So what was included within account 108030 is the cost to incur. And that's why the negative net salvage value, in setting that at an appropriate level in the depreciation study to ensure that the company is recovering those costs of removal concurrently from customers over time, is so important. So when we take a step back, and there were some questions throughout the proceeding regarding the gap associated reclass with cost of removal, the company has actually incurred cost of removal expenditures that are in excess of the accumulated depreciation associated with that. So just to stop there for a second and highlight what you're referencing in that T account for account 108030, I think what that's highlighting is that for cost of removal, FERC requires you to track not only the costs that you're incurring, which is what we're talking about and what is included as a debit balance within FERC account 108030, it also requires you to track the accumulated depreciation. And one second. Sorry, I just wanted to confirm. I think what we're trying to highlight there, I think that credit balance is likely highlighting the accumulated depreciation aspect. So in LFE 100, we kind of highlighted there when we were talking about the FERC accounts, like the two rates that are used in a depreciation rate. You have both the accumulated depreciation component as well as the cost of removal component, which represents the negative net salvage value that's included in a depreciation study. So just looking at these T accounts, I think that credit balance that's highlighted there is actually really included within 108010 in our general ledger. All the accumulated depreciation as it's accrued goes to a FERC account 108010, not 030. 030 represents only the costs that are of removal that are incurred. But just to circle back, to what I was highlighting before, I think it's illustratively, it's helpful to highlight that the way we did accidentally and not show the credit there, Because by design, cost of removal should be recovered concurrently from customers to prevent generational inequity. Customers in the rate-making environment should be paying for not only, the cost of the assets that they're consuming over time, but they should also be paying for, the estimated net salvage value at a later date. Because otherwise, it's, again, the customers of tomorrow would be paying for the benefits that the customers of today are consuming. And so it's just important on this point to highlight the vital nature of the negative net salvage value that's included within the depreciation study and ensuring that's set appropriately. The company does have cost of removal costs currently that are in excess of the accumulated depreciation that has built up. And so, it's important to make sure that the negative net salvage value, like Mr. Alice talked about in the evidentiary hearings, is set at an appropriate level to ensure that those cost of removal costs continue to be recovered concurrently from customers to prevent generational inequity.
So with this, with the example journal entry and RRU 100 attachment 1, is that not accurate in terms of how the company actually books cost of removal?
Okay, so just to take a step back, I think the credit that is highlighted there's one additional step that I neglected to reference as well. So just to kind of make sure everything's clear. So we'll take them in pieces. So when accumulated depreciation is recorded in accordance with the depreciation study that's approved by PURA and the rates that are used and set in the accounting system, those will be recorded as a debit to depreciation expense, and just to use simplistic terms, right, and a credit to accumulated depreciation. When cost of removal expenditures are incurred, it would be a debit to 108,030 and would be a credit to cash or AP, et cetera. I think what that credit value is trying to represent is that there's also an additional step just from a presentational perspective within the 108 accounts within our general ledger system, that when a work order moves to that final unitized state, we take the debit balance of cost of removal and we move it to FERC account 108010. It's just an internal presentational movement that we record for the final unitization. But I think that's what that credit represents individually in journal entry 3, and that's why it's equivalent there. That's just to represent an internal reclass that we do. But I think, as we've talked about, I think all the background to cost of removal and the way those journal entries, I think we'd have to consider all of them, but that's what that individual one is referring to specifically. So sorry for the confusion.
No, I appreciate your response. So my remaining question then, I guess, is that if that is the case, and if it sounds like RRU 100 attachment 1 is representative of what the company, how the company actually records these costs, if that's true, I'm just having trouble understanding how there's a balance of $141 million on the company's books.
So I think you can't look at that journal entry and that T account for 108030 individually. I think understanding and consulting with my colleagues behind me here, I think that journal entry individually is highlighting just an internal reclass that we have. So I think what you're not seeing here in these journal entries is the actual accrual of cost of removal as we incur the dollars. So that entry individually, I think, is simply representing a reclass from 108010 to 108030. And you can kind of see it from the highlights there in the column where it says 3. If you look in the debit column of 108010, there's a debit of $600 there, and there's a credit which corresponds with the credit in line 3 in 108030. And so that, I think what we're showing at the bottom, honestly, we probably use the same number to just illustratively, but I think the debit balance that relates to account 1, I think just would represent the costs incurred. It just so happens, I think when we did this example, we used the exact same numbers. So it's illustratively not really representing what's going on. The credit that's shown within 108030 is simply representing the movement from 108,030 to 108,010. And you can see that in the T account above, if you're following. And then the debit balance, the 1 represents a component, I believe, of, you can see the credit there in cash up at the top in the cash account. That would represent the costs incurred. And so I think illustratively, it's a bad example because we're using the same exact numbers to show the presentational movement. But I think what we're talking about and what is included within 108,030, what's included within LFE 110, attachment 1, represents the debit balance that's included within account 108,030.
Are you talking about the difference between the accrued cost of removal and the incurred cost of removal?
No, the accrued cost of removal represents the accumulated depreciation associated with it. That is recorded in full. The entirety of the depreciation is recorded within account 108,010. I think all we're referencing in this T account is that there is a reclass when a project is finally unitized, the cost of removal spend that was included within FERC account 108,030 for classification purposes is included within FERC account 108,010.
Oh, okay. If that's the case, why would there be a balance of 141 million in cost of removal? Why wouldn't all that be in?
It represents that there's an amount that hasn't gone through, there's a work order that hasn't gone through the full unitization process internally. It's more representative of the in-service classification. So that's just representative of the fact that work order hasn't gone through the final unitization to be completed in the system. That's all it is presentational. But the amounts that move from 108,030 to 108,010 are associated with a fully completed unitized project that has the associated retirement completed and is finalized. It's just an internal classification issue between FERC accounts.
Okay, so there's $141 million of cost of removal expenditures associated with work orders that have not been unitized, but only $11 million of that was related to items that did not have an associated completed asset retirement as of March 31, 2025.
Correct. When you look at 110, the way we tried to highlight it was to answer the question directly as to I believe the question was, that was clarified on day 6 of the evidentiary hearings, is that we were asked to present that information for projects that don't have a retirement. So of the 171 million, 141 million have an associated retirement date in the system with it. And just looking at the summary of the spreadsheet, there's an additional 17.9 million, oops, sorry, wrong period, $18.9 million that's included that has the new construction aspect of that project has an in-service designation. So the project has been completed, the assets are used and useful, actively providing service to our customers. It's just that there is not yet a completed retirement date of that asset in the system, but that's just in the accounting process to get finalized with a retirement date, which would happen likely in the near term. And then there's the remaining $11 million. And I think what we're highlighting there is those are projects that do not yet have, on a new construction side, an in-service designation yet, and do not have a completed retirement for the removal side of the equation.
And again, I think I can add a little bit why you might have new plant that's in service before, the old asset is retired. So there are some pieces of our infrastructure that are critical, right? We can't necessarily take an outage because that piece, that asset, right, that main, for example, is critical to serving downstream customers. And so we need to ensure that the new asset is in service and can then serve those customers before we can do the final work to retire what was previously providing that service. So there almost is an element of overlap for a lot of these assets where we cannot take the old asset out of service until the new asset is in service because we need to provide gas to customers.
And just circling back to my previous points about the 108 balance in general, we certainly, endeavored to provide the data in the way in which it was requested specific to retirements. But the reason the cost of removal expenditures incurred is included within FERC account 108, which is included within the cost of service, is because those costs relate to assets that were previously in service, used and useful, provided service to customers. And these are simply the removal costs that we likely, if in a perfect world, you could set negative net salvage, we would have been recovering through depreciation over the past 50, 100 years, whatever the specific project is.
Okay, I appreciate that. And I just have a couple more questions related to this, and I appreciate you indulging me here. But the amount, well, I guess the total amount on the company's books as of March 31, 2025 related to cost of removal, and that would be 10803, that account was 171 million. Is that correct?
That's correct.
Okay. If we remove the 11 million that the company described as not yet having an associated completed asset retirement as of March 31, and we also remove the 19 million of cost of removal associated with work orders with an in-service or completed status, then we get to the 141 million. And I just want to confirm this, is it the company's testimony that all of the assets associated with the projects related to that 141 million dollar cost of removal amounts, all of those have been completely retired and are off the company's books?
So what's being represented there is that the original book cost that was recorded is retired. It's important to just highlight, though, that by its nature, cost of removal is costs related to the retirement of old assets, which is why it's included. And that's why FERC specifically within the uniform system of accounts has required the presentation of cost of removal expenditures to be included within FERC account 108, which is included in the cost of service. It's because by its very nature, the cost of removal are related to the retirement costs of previously used and useful assets, which are reaching the end of their useful life.
What are the subsequent steps that the company would need to perform in order to ultimately move these costs from cost of removal to accumulated depreciation?
Cost of removal is included in accumulated depreciation.
Thank you. I was imprecise there, but from 10803 to the 10810.
It's just that the work order from an in-service perspective would reach its fully unitized position. It's just a simple internal accounting reclass that's done between two accounts. It's just for presentational purposes to show the amount of a cost of removal incurred in a separate GL account.
Can you define what those steps are?
It's the journal entry that's shown. It would be that when the asset is fully unitized, you would debit the 108,030 and you'd credit.
That would be the final step that would need to be taken.
The journal entry?
Yeah.
Yeah. So I think what's important to highlight there too is to just highlight, and both Mr. Kruger and Ms. Day can correct me where I go off the rails outside of my accounting knowledge, but from a constructional standpoint, it's important to put into context what we're doing. And so we're going out when we retire a main, for example, we're digging that up in the street. We're finding that main, we're cutting and capping that, or doing whatever, removal procedures the operations team needs to do to retire that. You're then refilling that, repaving that, there is a process. Whenever you repave something, there's a waiting time period where you have to make sure that that pavement's settled, it's settled appropriately. Because at the end of the day, our number one priority is to make sure that our assets are providing safe and reliable service to our customers. And so I think what this is highlighting, just I think talking about the in-service side of it and why there's a little bit of a lag there is because there are important, operational and safety steps that are required to ensure that when we've installed new main and we've retired old main, that all the additional steps we take are finalized and completed before you move it from FERC account 106 to 101. And that would be when that happens, when that step happens, is when you would also see the movement from a classification perspective from 108030 to 108010.
Oh, okay. So is the reason why there's such a large balance in terms of the $141 million of cost of removal, is that because the associated new asset has not been placed into service?
No, those assets are in service. They're actively providing service to our customers. We would not place an asset in service until it's used and useful and actively providing gas service to our customers.
So I'm sorry if I'm just being dense, but if the company has retired the asset that has replaced this asset is in service, why would there be an accumulated balance of $140 million if it's just a question of doing an internal reclass? I'm just having trouble understanding why there'd be such a large balance that would accumulate in cost of removal.
Well, we wouldn't do that reclass until the project is fully unitized and finalized. And like I mentioned, there's a period of time where the team can complete the work, the new main, and I defer to Ms. Day and Mr. Kruger to help support me from the operational front. But there's a time period where the new main is installed, it's in service, it's providing service to our customers. From an accounting perspective, we have to follow what's happening in the field. As that asset is providing service to our customers, that's a used and useful asset that from under the FERC rules and under the GAAP rules, we need to present that as an in-service asset and begin depreciating that asset. And even if the retirement is completed, it would typically be when a new main is placed in service, the retirement would follow soon thereafter to finalize that process. But all that we're showing here and what I'm referencing when I mentioned the reclass is just typically in the FERC space, it would move from QIP to 106 completed, not yet classified. And then once all the project is finalized, all the final steps from an operational perspective are completed, it will move from 106 to 101, and the amounts will move from 108030 to 108010.
And I'll just try and then, say Mr. O'Brien can correct me where I go off the rails, because there's a little bit of this, right, where it's a combination of what's happening actually out in the field and what's happening from an accounting perspective. So I think one thing that might be helpful to remember is that there can be a lot of work included on the same work order. So in general, a work order for a replacement job is going to include both the new installation and the retirement. And so because on that single work order, you can have the new main go in service before the retirement is completed, those get caught in that 141, based on my understanding. So when there's a portion of that work order that goes in service, then all of the charges that have been invested into the retirement of those assets then show up in that account, but the retirement hasn't been totally completed yet, so it doesn't have a retirement date. Once it is completed and it has a retirement date, then they can go through that final step of the journaling to move it from, I'm not even going to try to do the numbers, but from the first account we were talking about to the second one.
I'll just add a little context into the, operation perspective of what goes into a procedure when we're talking about putting a new asset into service. And Ms. Day mentioned the word overlap. There's a period of time when we put our new assets in service. And in an effort to abandon the old asset that could be 100 years old, the company starts transferring services from the old asset over to new, which could be a very lengthy process based off the size and scope of the project. And each one of these projects is unique in its own size. So we begin transferring the old services from the aging asset, leak-prone pipe, over to the new plastic asset or steel asset over a period of time. And as part of that process, crews are out actively digging test holes in preparation of a procedure. So from an engineering perspective, at the start of the project, we do a very detailed design. And we want to build to the design, but as we get into the execution process of these procedures to abandon old assets, as part of the field activities that take place, we dig many test holes to confirm the size, the condition of the main to make sure it can take on the new assets that we have to either weld on or fuse on to perform the abandonment process. And as we learn more information about those assets, that information comes back into engineering and we adjust the procedures to perform the removal or the abandonment of those assets. And I want to talk a little bit about what a procedure is, because back in 2018, we had a large-scale industry incident up in Merrimack Valley in 2018. And one of the NTSB findings and an industry best practice that came out of that was a detailed step-by-step procedure. And Eversource adopted that recommendation, and we have step-by-step lengthy procedure. So prior to 2018, these procedures could be 1 to 2 pages. Very, could be performed on the back of a crew truck when they're out performing abandonment work. Post Merrimack Valley, these procedures have gone to a step-by-step, 20 to 30 pages, very detailed and very precise, where any condition in that procedure that's not actual or factual based off the conditions that the crew have, they stop, they evaluate, and they confer back with our engineering team to assess and move forward with approval. So it's very timely based off the process, and it's a step-by-step, 2-signature, crew performing the work signs off, as well as a procedure supervisor. So these are very elaborate designs, elaborate processes and procedures that we have in place for the safety of the system and customers and crews performing the work. So it's a lot of detail and a lot of time and effort go into the work that's performed to make sure these assets are safely abandoned.
One follow-up question. I think that Ms. Day referenced that the amounts move between these accounts, which would be the cost removal account and accumulated depreciation, when there's a retirement date associated with the asset. Is that accurate?
Can you repeat that?
I believe she said that the timing when the amounts move between cost of removal and the 108010 accumulated depreciation account was when the asset had a retirement date.
From an accounting perspective, that reclass is performed, like I mentioned before, when the in-service side moves to the fully unitized account, when it moves to 101. That's the trigger to also reclass the cost of removal incurred. The retirement date specifically doesn't, if we had retired it today, it wouldn't necessarily move from 108030 to 108010 immediately.
Okay.
Yeah, maybe to clarify what I was trying to say, and then Mr. O'Brien can correct me. I just meant we can't really book the full retirement cost until the retirement's complete. So that's really what I was trying to say.
Yeah, and circling back to the accounting journal entries we talked about, I think what Ms. Day is referring to is from an original book cost retirement, that wouldn't occur until the retirement is completed in the system with the date associated to it. So what we talked when we started the conversation and we talked about the retirement of a previous asset that was in service, it would be the movement from crediting the 101 account and debiting 108010, I think is from a retirement date perspective, what Ms. Day was probably referring to.
Okay, and I think I just have one final question, hopefully, and that is the reason why there's such a large balance in the cost of removal, and I've used my own words, I know you didn't phrase it that way, but is the reason why there's a $130 million to 170 million balance in the cost of removal, because if we look back at the journal entries RU 100, that's because journal entry 3 has not occurred yet.
I think it's two things. Number one, that value is a gross value, right? So that's cost incurred. What's not reflected in there is the accumulated depreciation that's associated with the cost of removal, which is recorded to account 108010, which is when we were talking earlier about negative net salvage. That would be the build and the depreciation expense incurred associated with negative net salvage. So that's one reason. And the second is because that internal reclass that's highlighted in account 3 has not yet occurred, but it would be the combination of those both. And I think the other item to note too is the reason it is of that value too is because when you look at the capital spending program that the company has and the breakdown of where we've transitioned, I would say over the past 7-8 years, we are doing significantly more pipe replacements today. I think in 2024, it was over 50% of our total capital program from a spending perspective. And that type of pipe replacement does carry higher dollar cost of removal costs incurred. And there's certainly, I think, programs that Ms. Day or Mr. Kruger could talk to about, retiring those types of assets in that older pipe. But I think it's the combination of those three that's likely yielding the balance that's sitting within that account.
Okay. Okay, I appreciate that. I think I understand now. Thank you.
So let's change the topic a bit. Please open the response to LFE 102 and let me know when you have it ready.
Sure, I have it.
At the bottom of page 1, the company states, as outlined in the calculation above, the removal percentages calculated are the same as the amounts presented within LFE 101, attachment 1, except for fiscal years 2021 through 2023, where the company processed some accounting classification adjustments that were finalized at the work order level in 2023. Can you direct me to where in the record the company describes these accounting classification adjustments?
We describe them within, I think what we're referencing here, where we outlined that within QLFE 101. So, and the reason we did was because when you look at the activity that's broken out by year in LFE 101, that represents the actual cost of removal incurred at the work order level. And so what happened in 2021 was the company has a litany of internal controls that we have from an operational perspective, from an accounting perspective, et cetera. We're constantly analyzing these balances. What we found in 2021 is that the cost of removal incurred looked higher. The company went through a process to investigate that and identified an amount of removal that was classified too high. And so simply what we did from an accounting perspective is we reclassified the cost of removal spend for certain work orders through a journal entry to account to the in-service accounts. And then that was subsequently pushed down to the actual work order level in a future year to have that shown at the individual work order level. So that's all that's referencing, and where that is in the record and where it was first referenced was QLFE 101.
Thank you.
And just, sorry, one other point too. It's just important to note that number one, that's purely a reclassification between all within net utility plant. There's no impacts elsewhere. It's purely a classification item individually. And also it's important to note that all of that is reflected within the work order detail at the completion of the test year in 2023. I think we were just trying to be transparent to highlight that there is some volatility in the attachment to 101 when you look at the years 2021 to 2023.
Thank you. So please open the company's response to LFE 103 and let me know when you have it available.
Yes, I'm there.
On the second page of the response, it states work order 302-19462 is one of over 68 capital work orders included within the single pipe replacement project, correct?
That's what it states, correct.
Let's turn to the publicly filed version of LFE 103, attachment 3. Let me know when you have that ready. Page 1.
Page 1. Oh, sorry. Is that I'm in the Excel, is that the original summary that was presented at the evidentiary hearing?
The attachment 3.
Yeah, hold on, sorry, I'll open it up in PDF as well, sorry.
No problem.
Yes, I'm there.
Okay. So under the column labeled work order description, it mentions main cast iron 4.0 and main cast iron 5.0. These refer to 4-inch and 5-inch cast iron mains, correct?
Yeah, that's true. That represents the retirement of the old asset, the original book value cost.
Just a minute.
Just consulting with my colleague, we would just probably want to confirm what designation that is, just to make sure I'm accurately representing what the 4.0 and the 5.0 represent.
Okay, is a supplement or read-in?
We'll do a supplement, thank you.
Okay, so it's a supplement to LFE 103.
So just to confirm, do the mentions to the references to the cast iron and this work order, do they refer to cast iron main associated with this specific work order or the entire pipe replacement project?
I think this would be the work order. I think what we were trying to highlight in each of the responses is to really kind of take it up a level too, when looking at the analysis that was performed here. I think, what we tried to highlight in the response is, specifically from, evaluating the appropriateness of the spend, like comparing it to the book value on an individual work order. We just wanted to provide the additional context of the entirety of the project as well. So you could get the entire picture of not just the one individual work order within that project, but the entire picture of that individual capital project.
Understood. So if this refers just to this specific work order, has the company identified anywhere in the response to this LFE or elsewhere in the record the total length of mains retired specific to this work project?
Are you asking specific to the work order or specific to the project?
So as you just previously mentioned, the cast iron that we're talking about in this work order 302-19462, is just about the cast iron main associated with that work order, not the other 67 associated with this project.
Yeah, so just for context, all the way through the last row of where it says work order status and in service, all that data is representative of what was presented to the company at the evidentiary hearing. We've made no changes to that information. That's what Pura staff presented to the company to highlight those individual work orders. So when we were building the attachments, we just wanted to start with where the authority staff had what you had highlighted for us. And the only additional information we wanted to provide is that this work order does have a designation as an in-service work order.
Thank you. Understood. Could we get a read in for the total length of mains retired specific to this pipe replacement project as well?
Just a minute.
So I'm just looking at subpart A to the response. It looks like in each of those, we did highlight some specifics to the project to be to respond to the multiple prompts within each of these responses. And I think, for 103, for example, it does say it's approximately 2,500 feet of pipe and to tie over and replace 62 services in the city of Waterbury, Connecticut for this specific project.
Right, I misspoke there earlier. I meant the length of the cast iron main that was replaced specific to this work order, not the entire project. My understanding of the information we have now is that it shows the diagrams and so on show the entire pipe replacement project, not the specific work order. And so we're interested in the cast iron main associated with this work order, the length of main removed pursuant to this specific work order. Work order 302-19462.
Yeah, we could take that as either a read-in or a supplement. If we can have some time to maybe try to look and see if we can pull that quickly, we could do a read-in. If not, we'd be happy to take a supplement.
And I just want to confirm what you want is the length for this specific work order and not like specific engineered drawings for this specific work order, correct? Just the length?
Any, I believe engineering documents pursuant to this specific work order should have already been produced per the original LFE.
Correct, but it's on a project basis. So I just want to make sure that that's acceptable because we don't generate that level of documentation by specific work order. It really is for the project.
I understand that.
Thank you.
And so just to be clear, we'll start with a read-in. We'll see if we can pull that information quickly. If not, we'd be happy to do a supplement. But what you're specifically asking for is for this individual work order, you'd like the amount of feet that was retired for the individual work order.
And Chairman, I would have that as read-in number 8.
Yes, thank you.
Also, it would be more helpful if the information and the read-in would break it down by the sides of the main because the work order refers to 4 and 5 inch main. So ideally, the amount of 4 inch main, the amount of 5 inch main.
Okay. Just given, we'll go back and talk it through, but given that level of detail, we may need to make that a supplement. But again, we can confirm that after lunch. Just given the additional detail, it may take a little more time to break that down in more detail.
Understood. Has the company provided the year of installation for those assets anywhere on the record other than stating in the narrative response that they were placed in service prior to 1958?
You're talking for the retired assets?
The retired assets, yes.
No, I don't think we have. What is represented for each of these projects is there's retirement information spread across a variety of years. We tried to highlight in the response the range as well as, where those dollars predominantly were in the response. So for this one, for example, I'm seeing years from, and I think we highlighted this in the response, from 1905 to 1958 for the $6,371 that was retired for that individual work order. But is that listed individually at a work order level in the record? I have to defer to my revenue requirements colleagues, but I don't believe that is.
Yes, so we have not provided a completion date or cost of removal dates for individual work orders. So that is not on the record. We provided in the ENGs, ENG 001 and the subsequent supplements, the field completion for the entire project, but not at a work order level for cost of removal.
But your question was specific to the retirements of the original book cost, correct? Yeah, I don't think that's on the record.
I just want to add that that's a massive amount of information, right? So I I think you can tell just from that one page where we kind of show all of the different years associated with a single project. We maintain entire databases, right? Our geographic information system is really what we use to maintain that information. It is spatial as well, but it's a massive amount of information. So I think it would potentially serve to just add some confusion. That's why I think in the narrative, we tried to summarize like the general ages because there's just a lot. There's a lot there. We have a wide variety of types of assets across our system because of the ages going back, as Mr. O'Brien mentioned, sometimes over 100 years. So there may be some systems in the US where all of their assets are newer, but for us, even in a single area, you can have a wide variety of asset ages. So in a single retirement project or on a single retirement work order, you could have a massive amount of different ages of assets that are being retired.
But typically, just to talk through the process a little bit more broadly, right? When we are going out and doing this pipe replacement type work, you are typically retiring the pipe that has reached its useful life. And in some cases, as you've seen in the response, actually exceeds its useful life from a depreciation perspective. So, I think to be responsive to the question, we tried to provide that context to highlight the difference between the numbers and why there is a multiple that was highlighted at the evidentiary hearing. But like Ms. Day said, I think that would be extremely voluminous to go through at an individual work order level, which was why that's not included in the record.
So just to make sure we're not talking past each other, would the company not be able to provide the in-service dates related to these retired assets?
For these 5 or every retirement in?
For these.
Okay, sorry. We were under the interpretation that you were saying for the entirety of all capital additions. That's why we were saying it was voluminous. For these 5, yes, we have that data. Sorry. That would have been a very extensive response. I apologize.
So we are, just let me see if I can propose something to move us forward. I think we had already been under a request for a supplement to late file exhibit 103 from the earlier questioning. I wonder if since we have to supplement that we could just add those 5 in-service dates as well as the breakdown of the length of mains by 4-inch and 5-inch and just capture it in that supplement. Is that something that the company could do?
Would you like that like individually to each one of those, or should we just put it in one? Does it matter?
Yeah, just make it a supplement to each of the 5 LFEs.
Okay, and just to be clear, so it would be to highlight the retirement ages for the original book cost by year, and to also highlight the feet for the individual work order for the retired main and the designation of the type of pipe that was retired.
Right.
Okay.
And the length for each designation to if there are multiple lengths in a work order or multiple size of pipe.
Okay.
And just to clarify for the transcript, you asked for that for late files 103 through 107, correct?
Correct.
Okay, thank you.
And you said, Mr. O'Brien, you said retirement ages. I just want to make sure we're,
Yeah,
you're talking about the in-service dates.
The original book cost value or in-service date is
The
what you're
original
looking for.
in-service dates, correct.
Yes. Sorry.
Okay. All right, so we're all clear, which I think sort of negates the read in 8, and we'll capture that in one of those supplements. Okay, thank you. Attorney Coker, when you wrap up this topic, I think we'll take our lunch break.
Okay, that is all I had.
That was on. Okay. All right, very good. We'll take our lunch break and reconvene at 12:50, please. Any administrative matters before we resume?
Chair, just one matter. We were finishing a cross-examination before the lunch break on late file 103, and during the lunch break, the witness identified a very small typo on late file 103. I'd like to have Ms. Day just identify what that typo is and to correct it.
Sure.
Thank you. And good afternoon. So on page 1 of QOCC 103, attachment 3 redacted, I guess LFE 103, I'm sorry. Where on the second line, it says main cast iron 5.0, that should say main cast iron 6.0, and that is intended to indicate the outer diameter of the main. Thank you.
Okay, anything further?
Nothing further. Thank you.
Thank you. Attorney Coker, please.
Please turn to the narrative response for LFE 105 and let me know when you're ready.
I'm there.
On page 2 of this response, the company states that in January 2025, the Yankee operations team identified an adjustment in the accounting split for this work order, and that the company updated the accounting split, resulting in a reclassification of capital dollars spent from cost of removal to plant in service with no net impact to total utility plant in service. Can you quantify this adjustment and explain why it was necessary?
So I can start. Just, I think what's important, and we reference it in the response here, in LFE 110, we endeavored to really try to provide a full response to to encompass the entirety of the cost of removal process, as well as, you know, at the work order level, how that's processed, et cetera, et cetera. So when each individual capital project is unique, it has its own individual facts and circumstances and design and specifications. And based on the design and specifications at a compatible unit level, there will be a FERC split that's identified for the particular work order. And that will determine and outline what percentage of those costs relate to new construction activities and what percentage of the costs relate to cost of removal related activities. And so throughout the duration of a work order life cycle, the company will go through an as-built process to compare what conditions were in the field and how the asset is being constructed to compare to the FERC split that's identified in the system and is classifying the costs. And so Ms. Day and Mr. Kruger can certainly highlight the specifics as to this project, but one thing I think it's just important to keep in context for presentation here in the accounting is that this is purely a classification presentation between what costs are presented within cost of removal and which costs relate to the new construction and ultimately the amount that would be placed as an in-service asset. There's no impact for any sort of adjustment through the as-built process to net utility plant. And it's also important to highlight that in this example, as the as-built process was completed, there was a movement that was, I believe, in January of 2025, moving dollars from cost of removal into in service. There also may be projects where the company will go through and there'll be amounts identified where we think there'll be additional new construction that's built. And when you get out into the field, the conditions you run into may result in more removal work being needed. And so there can kind of be reclassifications in both directions. Just wanted to provide that context and highlight that it's important to note that from a net utility plant perspective and a cost of service perspective, there's no distinguishment. It's a classification item. But certainly Ms. Day and Mr. Kruger can highlight more specifics on the project to your question.
Right, as to why this kind of change was necessary. So I think really the overall framework of the story for this project is that there was a big change in scope. That change in scope was not driven by our needs. It really was because this was a municipal project. So to provide that first context for what's going on here. So our existing main, which is the outlet main coming out of a district regulator station. So very important for serving our customers, right? That's the whole feed downstream of the system for all of the customers downstream of that. So very important section of Maine for us is attached to a bridge. So now the municipality is going to get rid of and then reconstruct that bridge. So in our initial conversations with the town, we were working on a design that's kind of our normal preferred process, which is when they get rid of one half of the bridge, or they construct the new half of the new bridge before they demolish the old bridge, so that we can move our assets now onto the new bridge before we have to get rid of those assets. Because again, we have to make sure that over the entire lifetime of the project, the new bridge construction, the old bridge removal, we have a main that's flowing gas. So we had an agreement from the town. That is how we were going to proceed. However, after that, after we had already started working on our engineering design, the town changed their plan and they were going to demolish the bridge all at once. So that sets us already on a path where we need a new timeline because, again, we have to make sure that we have a new main. And when they get rid of the bridge, obviously, if we don't put a new main in by the time they get rid of the bridge, then we don't have a main there anymore. And that's we can't really allow that. So then the solution that we came up with was horizontal directional drilling that would be kind of parallel to the bridge and go under the river right next to our district regulator station on the west side. And that project got all the way out to being put out to bid. And that's actually what was used for the original estimate. However, after we put it out to bid, the town let us know that actually they couldn't accept that design. It was too close to the bridge footings. And so then we had to go and put it back out for bid again with a new design. Even that did not end up being the final design. The final design ended up requiring that in order to maintain that new required distance from the bridge footings based on the town's new design, we would actually have to go much farther east to the east side of our regulator station. And that significantly increased the distance of the horizontal directional drilling. And it also put us much farther away from the portion of the main that was being retired. And so I think a lot of that change that gets reflected in there is because the scope of what was ultimately put in service was different from what was used for the original estimate that drove the compatible units.
And just to kind of close the loop here from a cost of service perspective, it's important to highlight that for this adjustment, which was processed in January of 2025, that is currently reflected in the company's cost of service as of both March and May. The March reference is QLFE 001, and the May reference is QLFE 001 SB01. We just wanted to also provide context that given that reclassification was processed in January of 2025, it's currently reflected in the company's cost of service and classified correctly.
Thank you both for the explanation. Can you guys quantify the adjustment, or is that already on the record somewhere?
I think it's, hold on one second, let me just compare. Sorry, I just wanted to make sure I could compare it. I think it's about $1.8, $1.9 million in total of a reclassification. And again, just to highlight, there's no impact overall to the net utility plant in any of the cost of service schedules overall. And again, this reclassification from FERC account 108 to FERC account gross utility plant and service is reflected in both the March and May cost of service.
And I also just want to note, this is part of the process, right? So that's why we have the as-builting process so that we can ensure that the ultimate costs match with what was ultimately installed and retired.
Thank you. So you mentioned a number of revisions to the plan due to the municipalities changing plans. When did that go into service, the final plan? That ended up being implemented?
From a scope change to the project, or when did the asset go in
When was
service?
the asset put in service?
We would just need a second to pull that. Are you just looking for like a month and year? And if it's more efficient too, I think we'll have that in a couple minutes, but we could also just take a quick read in and read that in if, to not hold it up. It's just someone's gonna have to pull the work order in the system to see the date.
Okay, we can circle back to that in a few minutes, if not.
Sure.
Is the reclassification mentioned in this LFE reflected in the cost of service updates?
Yes, so just to highlight that, so again, as I mentioned, it's reflected in both the March and May cost of service updates. But it's also important to highlight that, you know, the reclassification would also be likely in the previous cost of service. It would just depend on when the asset was placed in service. But if the asset was placed in service to a net utility plant perspective and a cost of service perspective, that cost of that reclassification is just presentational in nature between the two FERC accounts.
Is this information also available in LFE one? And it's someplace in LFE one or not? The reclassification reflected in the cost of service updates, to be precise.
It's not going to be specifically shown, but both of those values, the amounts included within FERC account 108, as well as the in-service assets presented between FERC accounts 101 and 114, as I mentioned earlier, are both going to be included in the cost of service. And to answer your question, I believe the asset went in service in September of 2024.
Thank you. One moment. Is this adjustment also reflected in RRU 289 or its attachments?
Just a minute, we're pulling it up.
And I believe is that reflected in attachment 3, I want to say, was the original? Okay, I see it, yeah. So I don't believe it is reflected in that because the adjustment was made in January of 2025. And I believe that RRU 289 attachment 3 is as of December 31st of 2024.
So I'm looking at RRU 289. It appears it was filed in April. Can you explain why the adjustment is identified in January? It is not reflected in 289?
So I think in the question in subpart A, it says provide an itemized breakout for each year from 2018 through 2024. So although the request may have been in the month of April, the question was specific only through the fiscal year 2024.
Thank you. That clears it up. Please open LFE 98, attachment 1.
I'm there.
If the company reclassified capital dollars from cost removal to plant in service, or in other words, from FERC 108 to FERC 106, count 108 to 106, why does this adjustment not appear in the reconciliation of cost of removal and salvage and LFE 98 attachment 1?
So again, and you're talking specific to LFE 105?
Yes.
So again, I think LFE 098 was asking a question to reference that back to the original, I think, Schedule B 3.1, which was only through 2024. So again, because that reclassification was recorded in January of 2025, in order to reconcile back to the original Schedule B 3.1 that we provided, we wouldn't be able to include that here to show that because it hadn't occurred yet at that point in time.
Okay, makes sense. Thank you. Okay, in the FERC Uniform System of Accounts and 18 CFR Section 201.10, cost removal is defined as the cost of demolishing, dismantling, tearing down, or otherwise removing gas plant, including the cost of transportation, handling, and incidental thereto. How does the company apply this definition in situations where construction activities such as trenching or paving may serve dual purposes for both removing and installing assets?
Just want to see, does the witness need a chance to review that definition that was recited to you?
Yeah, would you mind repeating that for me?
Certainly. It's 18 CFR Section 201.10.
And when you say CFR, this isn't, I think you're referencing the FERC Uniform System of Accounts for gas. Okay, hold on one second while I pull that up.
We can put it on, if it would be easier, we could project it on the screen.
Oh, sorry, that's okay. I'll just search for the term, but
no problem.
Okay, I'm in the US of A. Could you just repeat the question one more time, please?
Yes, just the definition of cost removal in Part 201 of the FERC Uniform System of Accounts. They have a definition for cost removal, and the question was, how does the company apply this definition in situations where construction activities, such as trenching or paving, may serve dual purposes for both removing and installing assets?
One second. Yeah, so in our, as we, so I can certainly start with just the accounting process and the process in general, and then Ms. Day and Mr. Kruger could add some context from an operational perspective in the field. So from an accounting perspective, as we've talked about, every work order is unique, and each job and each work order has its own unique specifications and designs, which will, based on a compatible unit basis of what the job activities entail, will generate a FERC split to identify in the system which dollars are charged to the new construction and which dollars are charged to cost of removal related activities. And as we've talked about, throughout the duration of a work order's life cycle, the company will do an as-built process to evaluate the construction activities that have been completed to date, or if that is performed at the completion of the project, and will evaluate to ensure that the accounting is following the way the construction was actually presented. And as we've talked a little bit about, field conditions can certainly change as you get out into the field and you work through things. And so I would ask Ms. Day and Mr. Kruger to add any specific operational activities on how they can separate out some of those activities, but that's the overall background to the process from an accounting perspective.
Thank you. So I'll speak a little bit about replacement activities. So for replacement mains, when we're installing a new asset, it's fairly uncommon that we would have a shared trench for activities that would be an installation of a new asset, as well as an excavation that would permit us to abandon the old asset. So the sequential events that have to take place for us to get to the removal or the abandonment of that asset that we're replacing, we install new, we tie over all the services, and then there's a set of activities that take place: excavating, very particular locations to perform the abandonment. So this, we call them tie-in holes. So these tie-in holes are pre-engineered, designed, identified specific locations that are very common for replacement activities, but those would be separate excavations from an installation trench.
And I'll just add, they're usually performing those activities at different times. So in terms of tracking the activities of our contractors, it's easy to split between what work is being performed for the new installation versus what's being performed for the retirement.
I understand that in most cases this may not apply, but in a case where it does, where they may serve a dual purpose, how does the company distinguish between which category to put it in?
I'll clarify that comment. It's almost, from a construction perspective, we're not opening a trench, tying over a main. They're all part of activities to abandon a facility. I know I referenced it's uncommon, but it's almost nearly uncertain that would happen, that we would be installing a new asset in the same trench as an abandonment excavation.
Yeah, and just from, the accounting will eventually follow and catch up to the construction activities that are being performed. So as Mr. Kruger just highlighted, in an as-built process, we would evaluate how the asset was actually physically constructed and be able to work with our colleagues in operations and engineering to make sure that from an accounting perspective, that classification is following the way the asset was actually physically constructed. And as he mentioned, they do have an ability to break down the costs that are or the activities that are separated between cost specific to removal and cost specific to new construction. And again, just circling back to some comments earlier, this is purely a classification item that's required for FERC. And as we talked about before, and negative net salvage and the way depreciation is set up and functions, that's the reason why FERC has required that accounting classification difference.
And I'll add in particular to LFE 105, this had, I'll reference 4 very unique circumstances from a construction standpoint. We had a bridge, we had directional drilling, 16-inch large diameter cast iron, as well as a regulator station. So for us to encounter all 4 of those types of issues or hurdles in a project is very unique to have all 4 in one project. But I want to talk a little bit about, in particular to this project, the 16-inch main, which is cast iron. It's very large diameter, would be specialized crews, extra depth, because usually when we're putting the tooling on that would test and activate the fittings, the excavations are extremely large and they usually take several days to activate the fitting, perform the testing and the tapping of the fitting. So that's the activation piece that I was talking about. Then the crews come in and do some of the work that follows once we activate a main. And in this case, we likely come back and perform an abandonment with that same fitting. So we would re-excavate that location and put on the same abandonment fittings, which would go down and stop and isolate the old facility so we could redirect the flow of gas into the new asset. So in this instance, we excavated a similar location multiple times, but one was during the installation and the second would be during the abandonment or retirement of the asset.
One moment. Just to make sure everything is completely clear on how this works, I'd like to walk through a specific example. Please refer to the publicly filed version of LFE 104, Attachment 3, Part 2.
Could you repeat that reference one more time, please?
Certainly. It's LFE 104, Attachment 3, Part 2.
Okay. And is there a specific page there?
One moment. Page 3.
Okay, I'm on page 3.
Could you briefly explain what the line items in this document are?
Sure. So going back to LFEs 103 to 107, one of the requests was for all applicable invoices to that work order. And so the company provided not only the CTE invoices, which is more of the electronic process where we're, our vendors are using that updating constantly day over day the construction activities on the individual job, which is highlighted here in part 2, I believe. Oh, and I'm sorry, this may be the manual invoice. Or maybe it's both. Hold on one second, sorry. Oh, no, it's both. Okay, so on page 3, sorry, I'm in the PDF, not the Excel. So on page 3, this here highlights the manual invoices. So we have both what we titled on pages 1 and 2, the CTE invoices, which is what I was just describing, more of our process to directly communicate on the construction activities with our vendors in the field. And we also have manual invoices that will come in from various vendors. And all of these invoices typically can include multiple different jobs charged. Some of our vendors, for example, the city of Waterbury, I'm looking at on page 3, the invoices received there may relate to multiple different work orders. Our vendors typically can bill them weeks or months at a time and accumulate work on different work orders. And the company has a process to go through each individual invoice and specifically identify which work is performed where, to break that down and ensure that's appropriately charged to each of the applicable work orders. In addition to that, as we talked about, based on the design and specifications of the project, there will also be an allocation FERC split that's set up within the accounting system that will dictate how those dollars are translated into what relates to new construction activities and what relates to cost of removal related activities.
I'd like to direct your attention to, since we're using the PDF and not Excel, it's a little trickier, but please take a moment to find a row about 2/3 of the way down the page that reports an invoice from Layden Industries LLC for $114,000. Once you've looked at that row, just let me know.
I'm there.
What is the Eversource invoice number for this particular line item?
In the spreadsheet here, and when you say Eversource, what does that represent, that column?
No, it's just what the number itself, because we'll be referring to it again with the Eversource invoice number.
Sorry, hold on. I just got to line up my rows. I believe it's 91116557522.
Thank you. So is it correct that the page reference and attachment reference for this line item and the others in this attachment refer to the LFE attachment they're located that substantiates them, as well as the page number of that LFE attachment? I can rephrase, might have been confusing. For this particular line item, does the page reference and attachment reference for this line item refer to page 281 of LFE 104 attachment 4?
I believe it does. That's what is in the Excel.
Thank you. Let's turn to that attachment, LFE 104 attachment 4. When you have it ready, let me know.
I'm there.
Just in very general terms, please describe the document we are looking at on page 281.
So this is an invoice that's received from Layden Industries, and it is for, it looks like trench mill and paving work is what it says.
I also just want to note that the invoice also indicates the project number that it's associated with. It's associated with project number 23C216.
Thank you. Now please turn to page 283 of this attachment. Is it correct that this page 283 of LFE 104 attachment 4, this page includes specific areas that were paved under this invoice, including streets and total area paved in square feet, which are depicted as total SF?
Sorry, just 1 second. Yeah, I believe that's correct. I think that those amounts on pages 283 and then continuing on in 284 highlight the paving for the different roads.
Thank you. Are the lengths and widths of paving provided in the leftmost table, the one that has is labeled the 2-inch mill and pave on Will Street? Are the lengths and widths of paving in that table consistent with paving over excavations that would be performed to support both the installation of new plastic main and the abandonment of existing cast iron main?
So
Before the witness responds, is it clear just in terms of what's being requested? Because I just want to say, is your question specific to this, or are you asking to say, is it representative of some other projects? I just.
I'm asking specifically about this one.
Okay.
We're doing a case study.
Sorry, could you just repeat that question one more time?
Certainly. Are the lengths and widths of paving in the leftmost table consistent with paving over excavations that would be performed to support both the installation of new plastic main and the abandonment of the existing cast iron main under the project?
I just want to have a clarification. When you say consistent with, again, you clarified to say you're only asking for this particular project. You're not saying it applies to other types of projects. Okay, thank you.
To this project. I can make the question more granular if that'd be easier.
Yeah, if we could try it that way, Attorney Coker, thank you. Maybe that might be helpful if you could rephrase. Thank you for offering that opportunity.
So referring to the Will Street table, is it accurate to say that multiple entries describe lengths of 70 feet or longer?
yes, those lengths are in feet.
Do multiple entries describe lengths of 70 feet or longer?
Yes.
Drawing on your experience, is it accurate to say that paved areas of this length are consistent with paving along the axis of the mains versus the shorter excavations that might typically be made to tie over existing services or new mains?
Just a minute. I think Mr. O'Brien's going to take it I'll just say that to answer the question you most recently asked directly, I think we're, on the operations side, we're just getting a little confused because some of these links could be associated with services in addition to mains. But I think Mr. O'Brien's gonna try to address maybe the more accounting related aspects of this question.
So I think what you're trying to understand is how the specifics of the invoice are tying to the different types of work that's being performed. Is that what you're inquiring about?
Part of it, yes.
Okay. So I think to just take a step back, as we highlighted from a process perspective, when any work order is designed, it has its unique design specifications, and there's a FERC accounting split that's identified to identify what percentage of that is related to new construction and would be the in-service new asset, and what percentage of that is related to cost of removal. And that split is done in the system and then through what's performed on the operational front and how the asset is actually constructed. The operations team and the accounting team will go through an as-built process to determine how that asset was finally constructed. And if it's required, the FERC accounting split would be corrected, as you saw within LFE 105. But from an invoice perspective, the vendors we use, like I was highlighting earlier, may charge multiple types of work on an individual invoice. They don't specify within the individual invoice, nor do we direct charge removal costs individually. And I would like to highlight that in RRU 018 SBO1, the company did provide, I believe, all the invoices associated with the in-service, the assets placed in service in fiscal year 2023. In an attachment 2 of that response, in an effort to be as transparent as possible on how those invoices are tied out, the company actually went through and put together a roadmap which highlights the different types of invoices that we have, as well as provides some illustrative examples on how those amounts are tied back out to the individual work orders, which may be helpful just in terms of how that works. Obviously, I don't think this individual invoice may have been considered in that, but again, to get to how the amounts are split between the two, it's based off the FERC split based on the activities that are identified in the system.
I understand. I'm also trying to understand this particular project. So a lot of these questions are very specific to this project and this work order. This specific invoice that we are looking at here, drawing on your experience, is it accurate to say, or drawing on your knowledge of this project, is it accurate to say that the paid links indicated on the table for Willow Street are consistent with excavations that would be typically made to tie over existing services or new mains, or paving along the length of the main?
I think we'll take that as a read-in. I guess to clarify for the read-in, are you interested specifically for the work order or for the project?
Let's circle back to this. I think it'll get clearer.
Okay.
And I want to note, I'll just add in general in construction, a lot of the conditions that are set in our permits that we receive from these municipalities where we perform our work set the expectation on how we're going to restore our roads. So in particular, there's several conditions that would play into what the final restoration looks like. And a lot of it has to go with line assignment. So if we're a certain distance off curb lengths, then we have to perform a mill and overlay of 50% of the road. And it gets even more stringent when we go into state roads, when you think about the depth of the temporary trench and then the work that we have to do to perform the final trench excavation. And it is fairly substantial. So then when you look at services, there's a lot of factors that would play into how we're restoring our services as well. Because when you get into a residential street like this project, you could have services that we call long side, which cross the full length of the street, or short side, which are tie over short, smaller excavations. But when you have those in series and sequential, steps, a lot of the times we end up creating almost like a speed bump. And in an effort to eliminate that, when we work with the towns and we get the permitting, we have to have very specific conversations in our pre-construction walkthroughs about where the main is going to go, what the final restoration is going to look like. And they often put in this with mill and overlay for the width of maybe a 50% of the road, as well as when we have trench crossings that we have to mill in between to make that a seamless transition. And that's probably why you may look at this invoice and ask if they're common widths and lengths for our service line, because there's requirements that are beyond our control with the municipalities and states that put us into a mill and overlay for certain situations.
When you say it's outside of your control due to intervention of municipalities or other legal authorities, are you speaking in general, or are you talking about this particular?
In general, without knowing the specifics here.
Thank you.
And again, just to highlight the process again for how the invoices are processed, it would be how it's charged in the work order would be predicated based on the split. And when an as-built is completed for the work order, as you saw within LFE 105, if an adjustment were needed, it would be made. And ultimately, as I highlighted previously, overall, you know, for these assets or these work orders that are completed and in service, you know, any sort of movement, if there was anything, or true up through an as-built process, is purely a classification item between two FERC accounts. So just wanted to provide that clarity and context as well.
I'm looking at page, sorry, wrong reference here for LFE. Find what page this is. There's a depiction in one of the LFE attachment 4 of Willow Street, in question here, and it looks like we did have to do a substantial mill and overlay of that roadway. And a lot of the times, the discussion is, how old is the road? And when we start, you know, excavating, and in this example, you can see the roadway looks like there's a lot of what they call alligator cracks in the road, which when we're excavating, you know, make a larger disruption to the roadway. So when we leave a road, we want to leave it in as-is condition. And when we have that alligator cracking in the roadway like that, it's very difficult to put the road back in as-is condition. That's why I believe, based off the pictures that are attached, we would have to do the mill and overlay as a requirement in the community we served on this project.
Understood.
Referring to the picture on page 2.
I understand. I was actually coming back to that picture in a moment. In case, yeah, we could project it. I was going to project that picture, get some questions about it. So some of these questions will be a bit redundant, thanks to your useful answer, but I just wanted to go over it again. What in general is being depicted in this image?
This appears to be final restoration of the project, depicting a mill and overlay with a sealing of the joint between the new asphalt placed, line striping, as well as the sealant along the line of the existing pavement in the new asphalt.
Thank you. So the asphalt in this picture on the left side, it's a much darker color on the right. You mentioned the alligator cracks on the road. Could you just elaborate on that? Why are they different colors? Like, why is one side darker than the other? Newer?
Well, the trench in the middle is our new trench, and emulsion coming out of a asphalt plant is black. And when you have asphalt that's out in the roadway in the sun, it grays out, like you can see in both the east and west of this new trench that's in the middle. So it is typical that the existing asphalt has a discoloration based off the age that it's been, you know, out in the elements of the environment.
So in short, the darker is newer.
Yes.
On the lighter colored asphalt on the right, there are some painted orange or yellow markings. Could you explain what those are?
Appears to be existing gas infrastructure. Or, yeah, it's gas utility markings.
Are those markings consistent with the location of the original? So that would be consistent with the location of the original cast iron main.
I don't see notation on what type of main, but it could be the line of the main that was replaced, yes.
We have a minute to confer. We're all set. Thank you.
On the darker asphalt to the right of the median line, there's a square hole in the asphalt. Could you explain what that is?
It appears to be a curb valve box.
Could you explain what a curved valve box is for the record?
A curb valve box is a facility that allows, it's an extension, so a cover will be removed, as in this photo, the cover is removed, that allows gas crews to access a valve, which would be accessed to operate the gas facility, to put it in service, out of service, so we can control the flow of gas in the gas line.
So in short, it connects to the gas main, that box.
It does not connect, it sits above the sand padding, and it's not physically connected, but it is a insert that allows access to the facility.
So the main would be directly beneath that box.
3 feet or so, yes.
Thank you. Next, I need to ask a couple of questions that can only be addressed by reference to the confidential version of LFE 104 Attachment 3. I want to be clear that we are only interested in the accounting and allocation of a specific invoice in Attachment 3, and we do not intend to ask any information on the unit cost or pricing, unit quantities, rates, or fees that the company seeks to protect under Motion 112. In the abundance of caution, we will pause after each question to permit attorneys Pace or Tisler to raise any objections they may feel apply. This is acceptable to the company.
Yes, that's acceptable. So I appreciate the thought that went into that proffer. And yes, we can proceed question by question. Thank you.
Okay, thank you. Please open the confidential version of LFE 104 Attachment 3.
Do you have a page reference?
We will be working on sheet 3, WO detail.
Oh, I'm sorry.
In the Excel document, yes.
Okay, I'm there.
Please filter this sheet. It would be column AE. For this number, I'm going to give you a number for an invoice. The number is 91111655752. Filter for that one under column AE. Under column C, which is labeled FERC account, what account were these costs allocated to?
The FERC account identified in the column appears to be 108030.
Is that true for all the costs associated with this invoice?
1 second.
Could you please repeat that number to filter AE on?
Of course.
Thank you.
It's 91111655752. 7522.
Thank you. I missed that 6.
Sorry, could you repeat your question one more time, please?
Yes. Are is all the costs associated with this invoice allocated to the same FERC account?
In this individual filter that you've requested, the account listed in column C is 108030, which is cost of removal.
For all expenses?
For what is presented in this filter, correct?
And the filter that we applied was that invoice number that I just provided.
Correct. There could be other items impacting this that don't have that specific identifier. What we've provided in tab 3 here is the accounting detail for the entirety of the work order. So I would need to evaluate if there's other activities related to this activity elsewhere within the detail. But for the filter that you provided and requested, it's showing 108030.
Why are all the costs associated with that particular FERC account that are on this document, that under this filter for this particular invoice?
So again, that would get back to the original process that we talked about. So when a job is specified and goes through a design, a FERC split will be identified, and there will be a split between cost of removal, and there'll be a split between in-service. As the process works its way through and you get to a final as-built, if an adjustment is needed, it will be adjusted, and it will be for the entirety of the work order. And again, just to highlight, just for putting everything into context as we tried to in LFE 110, this is purely a classification item as it relates to what is shown currently in cost of removal and what is shown within in-service. And from a cost of service perspective and from an overall net utility plant perspective, there's no impact of the classification. When an as-built is done on the final constructed asset, if there were any adjustments that were needed, they'd be made appropriately to reclassify, as you saw within LFE 105.
Thank you. One moment, please. Okay, now I'd like to turn to the publicly filed version of LFE 105, Attachment 3, Part 1. This is the PDF one, not the Excel document.
You said LFE 105 Attachment 3.
Part 1.
Tab 1 in the Excel.
Part 1. This is the PDF.
Oh.
We're doing the public
Sorry.
document. No,
Sorry.
I understand.
I'm there.
What exactly is the other category of expense that this attachment mentions?
Could you reference where you're looking?
Certainly. One moment. So on page 2, sorry, my apologies, page 2 of this document.
Yep.
So there is a table of expenses and a category in the leftmost column is called other. What exactly does this expense represent?
Oh, I'm sorry. Yeah, so what we tried to do, there's a number of different types of information that would flow through. So what we tried to do was highlight in detail the most specific ones without giving you the list of every single accounting type that's in there. I think the majority of that may be direct labor, but we just tried to, for presentational purposes, condense those charges, but and try to break it out between third-party invoices, capitalized overhead, capitalized inventory, which were the predominant charges. And then for the other categories, there's a number of different charges like UVLs and UVRs, which we talked a little bit about yesterday. There's also, I believe, direct labor and probably some other charges as well that are broken down by asset category. We just tried to consolidate them for presentational purposes.
Would it be possible to get a supplement that itemizes the categories of expenses that are included under other for this LFE?
Sure.
And since it sounds like the other category is created for convenience, it would be ideal if we could get that for each of the 5 LFEs, LFE 103 through 107.
We can provide that.
Okay, and I think those are the same LFEs requested under the previous supplement, so I'll just ask that those be addressed in those in that supplement.
Hello again. I have a question related to the reclassification described in LFE 105. And it's not specific to this question, but I'll use this question as something to anchor our discussion.
And just to confirm, are you referring to LFE, an attachment, or just the actual question?
The narrative response.
Okay, thank you.
The narrative response on page 2, where the company says, as a result, in January 2025, the company updated the accounting split, resulting in a reclassification of capital dollars spent from cost of removal FERC account 108 to plant and service FERC account 106, with no net impact to total utility plant and service. If hypothetically this project had not been placed in service and was still under construction, would the reclassification have been from FERC account 108 to CWIP?
So just so I understand your question, you're asking if the asset constructed in the work order was not used and useful and was not actively providing service to customers, would the reclassification be from instead of FERC account 106 in service asset, would it be to QUIP?
Correct.
Yes, it would. But again, for this specific project, it is in service. And so that's the designation there is to FERC account 106.
I understand. And my final question is, I know that you referenced the several times how the accounting follows the work that's done in the field. I'm paraphrasing, but and then it's the company sets up the work orders that has the predefined split between cost of removal and the plant accounts. Is there written guidance that the company provides to its employees to help direct them to how to what work order to charge? Sorry.
When you say work order to charge, meaning like how to build the estimate? Is that what you're getting at?
If there was if there was a worker in the field and they're doing some construction activity, replacement of mains or whatever it happens to be, does the company provide its employees with written guidance regarding how that individual would charge their time?
So again, just to kind of go through the process, so an employee would charge their time to the work order. And I think they wouldn't charge their time and say it was designated to this type of activity or that type of activity. The way the dollars get split in the system would be based on the FERC accounting split that's identified in the system. And then as we've talked about extensively, it would go through the final as-built process. And if there were an update, it would be reclassified properly. And again, I know we're talking about cost of removal specifically here, but it's just important to highlight that can be a symmetrical movement, right? An ebb and flow between the two if there are adjustments needed based on changing field conditions from the original estimate.
Yeah, and I understand that. My question is how, if the company provides its employees written guidance that would direct them on which work order was appropriate to charge?
I'll defer to my operational colleagues, but I think that would be based on each work orders to the specific type of work that's being performed. So each of those work orders within a project would be specified based on what task they're completing or which work order they're working on. And I don't know if Mr. Kruger or Ms. Day would have additional comments, but
Yeah, I would, from a field worker perspective, service and main work orders are generated in the office and assigned through a planning and scheduling group. So they don't have the opportunity to select where their time goes in the field. So they have work management systems, mobile work management systems, where they're assigned on a daily or weekly basis, depending on the type of work, the tasks, which are assigned work orders through a planning and scheduling team. So the field workers don't have the ability to shift their time around.
And I would just like to add, because I think in our, in the prior hearings, I think Mr. DeRozier's talked about this, but our work orders are associated with specific assets. So it's essentially when employees are directed to work on a specific work order, their supervisor knows what assets are associated with that work order and would ensure that they're performing work on the right assets for the day that they were scheduled to do so.
And sorry, just to add to that, so, and just to elaborate on what Ms. Day said is, so when the field worker charges the work order, every week, the supervisors are required to review and validate and approve that timesheet. So there is a second level. There's a review and approval of that every week of those timesheets and where they charge their time.
And depending on the exact work order, that asset could include both retirement work and installation work, because the retired asset and the new asset are often linked in a work order when it's a replacement job.
Oh, okay, is there written guidance provided to the managers regarding how to structure the work order, and is that in the record?
when you say how to structure the work order, I mean, are you, I think your question is, do we have guidance on, we certainly, I believe, yeah, we certainly have general time charging guidance. But your question specific to the work order, I think the general guidance would be to, as we've discussed from, I think yesterday in the revenue requirements panel, from a revenue requirement or a time charging perspective for service company employees, you should be charging the time on the companies that you're working on. And what for your general time, it could be allocated. I see Ms. Peruta. So just to clarify the question, your question is, I believe, is there guidance from the company on how employees should charge their time to specific capital work orders generally? Okay. Okay, so I think that would fall under just our general time charging guidance. You know, in the operations field, a work order would be created by the supervisors to control the work that was being performed. And obviously the guidance to the employees, like it would be generally, is to charge the appropriate work order and the appropriate designations for how your time was allocated each individual week. And as Ms. Landry highlighted from a controls perspective, once that timesheet is created and submitted every week, it also goes through a review process with that person's immediate supervisor, which requires an approval to review that time to ensure that it was appropriately charged. And I think the time and expense policy referenced on the record is RRU 023, attachment 4.
Okay. Thank you for that. And I just have one final question, which is going back to something we discussed earlier. Can you explain why the company doesn't perform the final accounting entries related to its retirement until the new asset is placed in service?
Could you just repeat that question for me?
Yes. When we previously talked about the cost removal balances, you were saying that the cost removal doesn't get, and I'm going to paraphrase what you said, and so correct me if I'm characterizing it incorrectly, but I believe you said that it's not reclassified from 108.030 to 108.010 until the final unitization process.
Correct.
Why is that the case? Why would the company not do that entry concurrent with the retirement of the old asset?
So is your question specific to why isn't that done immediately when so just to take a step back, when the asset's placed in service, let's say the retirement's processed on the same day, is your question, why isn't the as-built done that day when it's completed, when the retirement's completed? Is that where you're going?
Well, we probably want to discuss this using an example where it's not the same day, but if the retirement is done today and the replacement asset goes into service in 2 months, why doesn't the company perform the final accounting entries related to the retirement today versus waiting until the final unitization process is complete?
And when you say the final accounting entry, is that what we were talking about earlier, the reclassification to move it from 108.030 to 108.010?
Correct.
So I think the reason is, you know, you have to go through the final as-built process. And as we mentioned this morning, when you dig a trench and you go through and you perform all the work physically in the field, you are then going to repave that, have to come back, reassess that, make sure that that's settled correctly to ensure that the assets we've placed in service are providing safe and reliable service to our customers. And that's our number one priority. So I think the reason that that final process doesn't take place right at the retirement is there's still an evaluation period to ensure we're at a completed construction point to finalize that movement. And that's when the asset is fully unitized and moved into 101. And just for, again, as we discussed this morning, the movement between those accounts is just in the internal reclassification process, that we don't move it from that individual 108.030 account to 108.010 until that final asset has reached a FERC account 101. And again, you know, it's important to highlight that the distinction between those two accounts has no bearing on net utility plant, also has no bearing on the cost of service. It's presented properly in accumulated depreciation as a cost of removal, cost incurred. And it's just that the reclassification from that individual account from 108.030 to 108.010 is completed when the in-service designation reaches 101, FERC account 101.
But these are two different assets we're talking about, correct? There's an asset that's being retired and there's an asset that's being placed into service. And I guess my question is, why is the timing of the asset being retired dependent on the asset that's being placed into service?
But the asset has been retired in your example, right? So the asset, the original asset, I think we're talking about different things.
So when you speak about the
Yeah, I'm sorry to interrupt you, but I think you're right. I misspoke there, or I was imprecise at least. The asset's already been retired, but the final accounting entries that's performed, the final accounting reclassification has not been performed. Correct. It hasn't gone from 10803 to 10801. And my question is, why does that reclassification have to wait for the new asset to be placed in the service?
Yeah, I think it's that the work order is linked, right? There's on the work order individually, there's both new construction activities there is removal activities on the work order. So like I mentioned, like there may be a period of time before it reaches its final resting place from an in-service perspective in FERC account 101, where the company is coming back to the field, reevaluating the paving and making sure that it's settled properly, that there's no risk to the asset. It's going to continue to provide safe and reliable service to our customers. And from an internal perspective, again, just to take a step back, it's strictly a presentational item between two individual FERC accounts within our general ledger system. And I believe when it reaches its fully completed status, I believe in the FERC US of A, there also may be a designation that would also be the trigger as well. I'd have to look through that and find that. But again, it's just an internal policy presentational item. It's just important to highlight again that there's no impact to FERC account 108 as a result of that reclassification. It's simply just between two accounts. And we've waited, sorry, Ms. Day. And we wait until the work order, since there is activity for both related activities on the individual work order, we really wait until it's reached its final state to make that reclassification for both.
And we're just going to confer real quick on a point of clarification. Thank you.
Yeah. So again, just to close the loop, it's what we talked about, right? That the company has, given these work orders contain activities for new construction as well as removal related activities. We don't move it to a final state between those two FERC accounts until the work order has reached its final state in 101. It's just a policy for ourselves that it makes sense to keep it separate until it's reached its final state.
Okay. Okay, thank you for that. And would there be a time during this process where cost of removal costs could no longer be charged to the work order?
So again, cost of removal costs wouldn't be charged directly. That would be just charged generally through the work order and then be allocated based on the FERC split. But let me just confer with my clients, my colleagues on when that work order is closed. Okay, so sorry. Generally, I think there's typically an annual period to wait to officially close out the work order for the reasons we talked about from an operational perspective. You want to make sure that from a paving perspective, anything for pipe replacement, for example, that you've dug up settles properly and that there's not additional work that needs to be performed to ensure that the assets that have been placed in service can continue to provide safe and reliable service to our customers.
Okay, and when you talked before about how the work order is split between the different FERC accounts, that's done at a work order level, is that correct?
That's correct.
Okay, so if an asset is fully retired and it's off of the company's books, if that work order is still open and employees are still charging invoice costs or time to that work order, cost of removal would still be getting charged, correct?
So again, I think the next step in that process would be the final as-built to go through and evaluate the final construction period. So again, that estimate holds until it reaches the final as-built state where you finalized everything and compared the complete construction of the project or the asset. And that's the point where you would trigger, if necessary, an adjustment to that split. So I think technically your question is correct, that would it show that way? But again, that's predicated off of the progress of the project, the continuous evaluation of the as-built throughout the work order life cycle. And then if there were additional charges on the back end, it would just be, if there were any needed adjustments, it would get caught through the final as-built process when it's finally moved to 101.
And I'm almost finished, so I appreciate you going through this with me. But the work order you were saying would have both the installation of the new asset and the cost removal of the old asset associated with it. That's what you're saying.
So there'd be at the point of initiation and throughout the project, there would be a FERC split to allocate the costs between what is identified for new construction and what is specific to cost of removal. And as those charges come through that work order, those costs would be allocated based on that charging. And as we've discussed, the company would go through an as-built process throughout the work order life cycle of the work order to continuously evaluate the construction to date and compare that to the work order split that was set up. And if adjustments were needed, they would be made. As you saw within LFE 105, when that adjustment was made, it moved dollars from cost of removal into in-service. And like we've talked about, it's a symmetrical relationship. There can be changes in the field where you think, you're going to do a certain percentage of new construction work. And when you get out there, conditions in the field change. And then when you get to an as-built and that process is adjusted, there could be some movement into if there were more removal dollars based on particular activities, construction activities that occurred in the field. So it's a continuous process based on a percentage that's set for all the costs. And then at the final state of the construction being completed is when it would go through that final process one last time, which is required for it to occur before it can close to 101. That's the point where it would reach its final percentage if there were any necessary adjustments.
Okay, I believe Mr. Kruger or Ms. Day were talking about this previously, but it sounds like these are fairly discrete activities between the removal activities and the installation activities. So is there a reason why the company doesn't separate the work orders?
So I think at the work order level, right? At the work order level, you would have, I think your question is, why wouldn't we have, instead of having one work order, why wouldn't we have two where we can clearly separate the removal dollars from the new construction? And I think there's a number of reasons. Number one, I think when you look at the number of work orders that we have, just in a given year, it's likely in the thousands, if not, and again, subject to check. I don't keep track of the running total, but it's likely thousands to the tens of thousands of work orders that are processed each individual year. So just to track that additionally between the two would double that number and produce a lot more volume of those individual work orders. Also, just to highlight from working with our vendors typically they have their own processes to bill us. And as we've talked about, and as is referenced in the roadmap in RRU 018 SB01 attachment 2, many times the work orders that are charged, and I think this was also identified in the audit process going through the reconciliation of some of the invoices for the in-service additions, some invoices may have multiple individual items included on it, multiple work orders, and those are then each of those invoices, the company goes through to allocate those out appropriately to each individual work order. So in order to really track it at a direct cost level to separate the two individually, we would have to have our vendors invoice us at an incredibly precise level by hour for the individual activities to be able to separate those charges appropriately as well. So I think given the volume of the additional work orders it would create, which would require additional staffing to work through that and analyze that, in addition to the fact that, you know, our vendors invoice us in underneath their own policies and procedures, you know, we wouldn't necessarily have that ability, I don't think, to break that out at such a finite level.
I'll also just, oh, sorry. All right, maybe we'll take turns. Sorry, Ms. Landry. I just wanted to add that, you know, kind of more from an operational or engineering perspective, you know, we certainly do have retirement-only projects or new install-only projects. For us and with our employees as well, we really do a replacement project generally at the same time, right? And so like when we are working on an asset that is going to be retired and replaced, it makes sense for us to consider those and have that work charged to the same work order. I think it helps us keep in mind the asset that it is that we're working on.
She said what I was gonna. Work orders are set up.
That's all my questions for this panel.
Thank you.
Thank you. We'll transition into cross-examination from the Office of Consumer Counsel, please.
Good afternoon, Tom Wheeler from the Office of Consumer Counsel. My first questions are about the narrative response to LFE 118. And actually, I'm sorry, they're about both the narrative response and attachment 1 to LFE 118.
Okay, have it up.
Okay. The narrative response notes that this, I guess I should, for background, maybe just to get everyone like back to where we were a couple weeks ago or whatever. This late file was asking about project 200306. That was the project that we discussed during the hearing that had a supplement request form that was submitted on February 26, 2024, and I had some questions about like why that supplement request form appeared to have been submitted later than the project completion date. And I recall all the answers as to that. So that this narrative response indicates that the project was finished in 2023. Do you know the specific date that it was completed?
I'm just going to pull it up real quick. Thank you.
Sure.
I'll try to pull it up. We have to go into our system to grab it. So if you want to continue with questioning while I do that, that might be a better use of our time.
Sure. I just wanted to confirm some like baseline questions about the attachment. Then I noticed that the narrative response indicates that the attachment 1 shows expenditures by month and year, and I was kind of staring at this for a while, and I think I kind of understand how it works, but just to be clear, on attachment 1, where it says month number, are those numbers there the full year followed by the calendar month? In other words, for example, line 1, where it says installation labor, there's a month number 202005. Would that be May of 2020?
Yep, Attorney Will, you have the nomenclature correct. Yes, it's
Okay.
year and month, yes.
Thank you. And are these looking again at attachment 1, using again line 1 as an example, that very first amount for internal labor was $25.38. I assume for internal labor, what that's showing is that in May of 2020, the company incurred that expense. Is that correct?
Correct. That's identifying labor from a internal employee of Yankee Gas, correct.
Okay. And then I just wanted to confirm that that's similar for like external vendor invoices. So using line 11 as an example, and again, these are all just examples. I'm not asking about the specific invoices or what they're for, but line 11 looks like it's a vendor invoice for $728.07. And it looks like what this is indicating is that expense was incurred in November of 2020. Is that correct?
That would be correct.
Okay. So these aren't like for the vendor invoices, they're not the dates they were billed or the dates they're paid. They were like, would it be the dates that the bills were received?
These are the dates that, I'm sorry, these are the dates that are processed within the system as the actual dates of the cost.
Okay. So would it be like, and again, I don't certainly want to ask the company to pull up one of these hundreds of specific invoices, but conceptually, would it be like this Feeney Brothers invoice might indicate the date that the service was performed on the on the invoice itself? Would that drive sort of the date of incurrence?
Yeah, so the month number here and the year number is the date of which the invoice was paid for the particular vendor.
Okay, paid. Okay. Thank you.
Attorney Wheel, as we're talking about contractor invoicing, I think it's important that I talk a little bit about the daily activities that take place. So every day that a contractor works on property for Eversource, they create a DAR, which is a daily activity report, which depicts all of the activities, material that's used, excavation, all the work that they perform, even on rain days. If they don't perform any work, a daily activity is created to document all of that work. Once a daily activity report is generated in the system, it automatically generates what we call a CTE, which is a contractor time and expense report. The contractor companies, it's basically the contractor company's invoice that they would submit to the company for review and approval. Every day those are reviewed and approved. The DARs generate a CTE, and there's a process that the company and the contractors meet to evaluate and approve those. And if there's any disputes for reconciliation, there could be a gap in time from the time work is performed and the company ultimately accepts, which could impact that month number of the accrual.
Okay. So does that mean that like since these are indicating payment dates, that the payment date might not necessarily indicate the time at which the work was performed because it could have happened?
It could reflect that, yes.
Okay. But is it also true that it could be like later, I mean, having done a little project management myself, I know like you don't always get, sometimes you have delayed invoices, right? Sometimes you're chasing after people being like, where's that? You got to bill me for that work you did a couple months ago. Or sometimes, there's just a delay in the processing of invoices. So is that all true of, I guess what I'm getting at is, my understanding is that these month dates indicate the date of payment. So is it true that it doesn't necessarily tell you exactly when the work was performed?
And you're referencing the exhibit provided, right? The attachment. Right?
Yeah.
So these are the dates of when the invoice was paid. So from a standpoint of what you talked about for project management, not only those two examples that you provided, but also, as Mr. Kruger described, through the CTE system, there are times when project managers who are responsible for the project will also not approve an invoice for payment. So you would have an invoice that would actually have an invoice date on it from the vendor when they submitted the invoice. But these are the dates that were actually paid.
Understood. Thank you.
Sorry, Attorney Wheel, to interrupt your train of thought. I have a bit of an answer about that specific part of the narrative. In that part of the narrative, we were trying to describe the city's project. So that specific paragraph where it talks about, sorry, just a minute while I bring it back up. Where the project, that entire paragraph beginning, the project was designed in the fall of 2020. And then the City of Waterbury's roadway improvement project. So then the next sentence is actually intended to reference the City of Waterbury's roadway improvement project. So that's what was proposed to begin construction in Q4 2020 for 75 days and then ended up taking over 3 years. So I apologize, that was confusing to follow in there.
Thank you. Does LFE 118 attachment 1, like I can look at this and see when the last invoice date, like I could look for like the latest date on here among the different classifications of invoices, but that's not going to tell me when the project was complete, right? Actually, for the reasons I was just asking about. So does the company have a project? I'll back up a little. We also talked a lot at the last hearing about the distinction between the in-service date and the total project completion date. Do you know what the total project completion date on this project was?
So Attorney Wheel, as you noted from the evidentiary hearings a couple of weeks ago, you're right. We have on the record, we have put the field completion date in our ENG 001 supplements. The latest supplement is on supplement 5. As we spoke at the last hearing, we also talked about these punch list items that could continue to be, working towards the project. I believe if we look at some of these projects in this series, you will see that there's 2025, charges on some of these projects that we're most likely going to discuss between 118 and 122, I believe, if my number's correct. So we have provided on the record a field work complete dates.
Okay, does the company not track though, like total? I always get confused. In the world I used to operate in, which was not public utilities, there was the substantial completion date, which I think is the equivalent of the field complete date. Is that correct? Like that's the date at which the people can start using it, even if you still gotta, in my former life, you still had to paint some trim or like install some hinges, that kind of thing.
So as we've described, through a number of our data requests, we have a funding project, and then under the funding project, there could be one or multiple work orders. We're putting work orders in service, and when work orders go in service, that portion of the work, as you define as being energized, useful for what your customer can be using to take gas. So we don't put projects in a completion date of, okay, the project's 100% complete, if you will. We put the work orders in service.
Okay. Understood. I just had a couple other questions about kind of how making sure I'm interpreting these. And by the way, you might be relieved to hear I don't think I have a bunch of questions about the other 12 attachments here, because most of my questions are just making sure I can read all of the attachments similarly, because they're all kind of work the same. I just want to make sure that I'm kind of, I guess like as a baseline, looking again at this attachment to page 1, starts with this cost category of installation labor, and then those capital expenditures go on down to the very bottom of page 6 when it kind of switches to the material category. Am I understanding that right?
Correct. During the evidentiary hearing, when we were talking about this particular late file, we said that we would provide the cost based on cost elements. So we bucketed the charges for materials, labor. I think it's about a half a dozen categories here that we have categorized the work. So installation labor, so that's both contractor and internal labor. We have the material. Paving is also another one. We have traffic and police services. Those are all cost element categories. You'll also see other on this particular project. This other appears to be, these are to either the state or to the city that the work was done. So it was could be permitting or other costs that the municipality or state charged to the company for the work.
Okay.
For services for the work.
Thanks.
And then we also have the indirects and the overheads as another category as well.
Yep. Okay. So going back to page 6, and again, this is just an example because it's the first kind of break between the categories in attachment 1. So if I look at line 314, which shows, as you referenced before, actually, 2020, May 2025, looks like there are 2 capital expenditures for internal labor in May 2025. Does everyone see that? Okay. And then if I switch down to lines 317, I see what I think is the first capital expenditure for material, which is July 2020. Am I understanding that correct? I guess what I'm getting at is just confirming that the kind of chronology of spend resets like when the categories change. Is that correct?
Correct. And just going back to the last line 321 and 322 that you mentioned on the internal labor, that looks to be in a correction there. $6,100 was charged to the project, and then $6,100 is coming out. But correct, under material, that was the first charge for materials on line 324.
Okay. So yeah, I was just trying to make sure, like if I wanted to know, if I'm scrolling all the way back up to page 1, if I wanted to know as of September 2020, what the total aggregate capital expenditure on this project is, I couldn't just look to line 8, which is the last capital expenditure in that month, because that would only show me the installation labor, right? I need to do the same thing for each.
For each category, that's correct.
Okay. And then also, if I were to do that for this category, again, just going to line 8, that the expenditure on line 8 is for $10,823.20. But if I wanted to know how much was spent as of the end of September 2020 in this category, I'd add up that number with every number that comes before it, right? So I'd add up the amounts in lines 1 through 8.
That's correct. Yeah, I'm just looking at that particular charge. It appears to be a UVL for the contracted work, but yes, that's correct.
Okay. And then you were mentioning before, and I noticed that it seems like there are negative charges in here that I assume are corrections or overbills or things like that.
Adjustments, correct.
So if I, for example, wanted to do the same exercise I just talked about, and I went down to, again, just an example, line 32 still on page 1. Since that's a negative number, if I wanted to do the same exercise to sort of add up everything that came before it, that would be inclusive of that debit, the one before it. There's also one on. So I guess just to confirm, I would add up the total sum inclusive of the signs, whether they're negatives or positives, and that would get me the total net spend as of that date. Is that correct?
That'd be correct.
Okay. I'm just making sure. Yeah, so I referenced this a second ago, but just for the record, the attachments 119 through attachment 1, I guess, to LFE 119 through 122, they looked to me to be structured, although the invoices are obviously different, the amounts are different, sometimes the categories differ. My question is just, if I ask you all the conceptual questions about how to read the attachment 1 to 118 as to all of those attachments, would the answers all be the same?
Conceptually correct.
Okay. Thank you. My next set of questions are about LFE 123 attachment 1.
I'm there.
Thanks. So I saw in the narrative response to 123, late file 123, that this is a spreadsheet used to track the meeting notes. And is this for the meetings of the project sanctioning committee?
That is correct. So for the project sanctioning committee meetings, all projects that are coming before the committee are documented in the spreadsheet format that you've seen. And then they're noted whether or not they were approved, or, as we have in attachment 1 here, various reasons why the project may not have been approved at that time at the sanctioning committee meeting. But I want to note just on 123, the question was, were there any projects included in this case that had not been approved through our policies? And we answered that that is not the case. Well, you see on this document that something's not approved. It was not approved at the sanctioning committee level, and the project manager came back and re-presented the project, or scope of a project was changed. But just to be clear for the record, that there's no projects that were rejected under any of our policies that landed within the case.
Okay. Thank you. I appreciate it. I was actually gonna kind of set the stage and remind the panel, the reason I asked for this was I think it was in response to my question my question was of the nature of like, is there anyone at any stage of this checking to say to these projects and potentially saying like, this costs too much? I think that was what I was trying to ask. And my understanding is that this late file exhibit is offered to support the testimony that was at the hearing, that yes, that there are processes and this is one of them. Is that correct?
It's correct. And I think, at the last hearing, when we had this discussion, we talked about all the various touch points that we have for project review, not only the formal at sanctioning committee, but also the monthly meetings or weekly meetings, and quite frankly, some of the meetings that will take place boots on the ground in the field about a particular project and circumstances that are arising. So these two attachments that we're providing are showing that, to your question before, yeah, there is oversight, looking at cost, leadership asking project management to go back and relook at those costs. Why are we doing, certain number of test pits, and maybe we only need to do X number of test pits and look at your estimates. So that process is happening in various formats, but from a documentation standpoint, we offered attachment 1 to 123.
Thank you. So I just had some questions about the reason I was going to kind of set the stage of that question was to explain, that's what I was looking for in this exhibit. I was looking at this exhibit and I said, okay, where can I find cost control examples? And I think I found some, and I wanted to talk about them. So the first on line 6 of 123 attachment 1, there's a note in the note section saying that Mr. Kelly wanted to make sure that we are not adding costs to the project that are unnecessary. Would that, in your opinion, be an example of the cost controls that were referenced during the hearing? If you look.
Correct. Yeah, we're looking at project 21C 705.
Yes.
Right? Yeah, that would be exactly the case. I think, leadership is looking and sanctioning committee meeting for these level of projects to go to sanctioning, and they are reviewing the estimates that come forward and ask project management various questions. And in this case, Mr. Kelly is asking to make sure that we don't have any unnecessary costs in the project.
Okay.
And I'd like to add, specific to this project being 4.6 million, Mr. Kelly was the vice president of operation at the time. And the line of questioning that he had, in my opinion, is driving the construction team and the engineering team to ensure that we looked at all of the options and selecting the most cost-effective route. And that's fairly consistent with how these meetings go in sanctioning, where there's a lot of line of questioning from the director level vice presidents on these types of projects.
And I just want to add, I think, because as I think we've tried to, or as we've tried to put in the record before, the audience at this meeting is that level of leadership, right? So I'm glad that you're asking these questions, because I think we can provide some context that might not be obvious to people who don't read these notes and participate in these meetings all the times. But even that first line for that project 21C 705, that G. Hill and K. Kelly would like to explore an alternate route that would take the project off state road. That's because we know that state road projects can be really expensive. They can be hard to coordinate, and they usually have more extensive restoration requirements. And so that's part of also the cost concern that's documented in there.
Thank you. And I noticed, so this line 6 that we've been talking about for project 21C 705, it looks like these notes are from a meeting on May 16th, 2022. And at that time, the project was proposed at the $4.6 million number. Is that correct? And I ask because I noticed immediately after that, it looks like the project came back at a meeting a couple months later on July 26th, this time for a slightly less lesser amount of money, and I saw that there were still comments that seemed like there's a note on line 7 saying that economics at 4.5 million might not justify having this be a reliability project. Just want to make sure I'm understanding, is that sort of what happened here? Is that like this got at the initial meeting in May, it was not approved, and then it was raised again at this other meeting in July at a different cost proposal?
Not having been there myself, but having been at other meetings, what I would say is, based on the notes, they were kind of asked to, look at or relook at some specific options. And it seems to me like the team came back and said, we looked at those options and these were the only cost reductions we were able to do. But the leadership team still said, that's insufficient. You need to come up with another option.
Thanks. Yeah, and I saw the note there on line 7. There's a note that says, should we be building this rather than rebuilding Oxford Gate? It also said, instead, we should see if there are other options with the station. I was just curious, I did look up this project number in ENG5 across the very many attachments that we talked about before, and I couldn't find it, which suggested to me that it doesn't yet, there is none, as far as I can tell, there is no plant in service associated with this project number. But I was just curious, based on this note, if anyone on the panel knows if this project went forward under a different, if there was under a different project number, or if there was some solution that resulted from this conversation, or if this was just kind of dropped altogether. Sure. If you could, if the answer is yes, if we could just have the project number, if there's a new project number that like this project kind of morphed into, that would be great. Back to LFE 123 attachment 1, the same thing we've been talking about. On line 11, it looks like the notes for this project at this meeting, it says review reasons for choosing high-priced contractor. Would this also, in the panel's opinion, be an example of the company implementing cost controls at these meetings?
Can you provide I'm sorry, Mr. Kruger, go ahead. I was just looking for the line item on this one. I'm sorry.
It's line 11, and it's the, I always confuse myself. It's Excel row 15, but it's labeled line 11, and the project number is 22C712.
Thank you for that. Sorry, Mr. Kruger. Didn't mean to interrupt you.
What I was going to indicate is that this looks like it was a supplemental that came to the sanctioning committee for approval. And at the time, the vice president of operations was questioning contractor selection. So there was likely a discussion amongst the group on how we coordinated the specific contractor who executed the project.
Okay.
Yes, that, as we discussed previously, supplementals are used for learning improvements. So if this was an area where we were looking at contractor utilization for cost-effective measures, this is certainly an example of those types of discussions.
Okay. So I did the same exercise I mentioned before, where I went back into the exhibits and searched for this project number. And this one I did find. And the reference, I don't know if it matters to you, but the reference for ENG 001 supplement 4 attachment 1B line 78 shows that there is plants in service associated with this project number. And that has a reference to YGS capital 3A, page 364. And I noticed when I went to that page, that page is the project authorization form associated with this project. And the presumed approved cost of that project is identical to what's shown on this form, $1,525,354. And I didn't see a supplement anywhere in that documentation. So should I take all that to mean that the high price contractor was ultimately determined to be justified?
So again, the supplemental came to committee as $1,525,354. it appears after completion. So it came through, but I want to remind, we did discuss the process when projects are underway, that we have a lot of cost controls and discussions that happen throughout the life cycle of a project. It's not only sanctioning, it's not only at the time of creation of a supplemental form, it's during frequent weekly meetings that we have with project management, planning and scheduling. So we have weekly active discussions amongst operations, which includes maintenance and construction, as well as engineering and our project management teams, as well as monthly project management meetings, weekly meetings with our contractors. So these discussions where we do have cost creep or scope creep or project changes, those are discussed and actively known about. We don't wait for a supplemental. The documentation is really kind of the final piece, but those discussions on projects are actively happening outside of the creation of a document.
And to add to what Mr. Kruger is saying, because we do think that it's important documentation for learnings, what the comments here indicate to me is the reason why it was held, essentially not approved at that time, is because the Vice President of Operations believes that an important element of why a supplement was needed was the original choice of a high-priced contractor, and so he wanted the supplement to be rewritten and resubmitted for approval, including that reasoning that he thought was integral to why that happened, or they otherwise needed to explain why that wasn't part of why the costs went over and required a supplement.
Okay. I'm a little confused. I gotta try to open up. Like I said before, I didn't see a supplement in YGS Capital 3A. Like with the PAF, as I recall, for this project is on 364, but there was no supplement. Do you know why that would be?
Would you mind giving us the page reference again for
Sure.
3A?
It's 3A, page 364.
Thank you.
I'm also opening it myself, and I could have been looking at a supplement and thought it was a PAF or something, so we'll wait and see.
So if I may, Mr. Will, to answer your question, and others can always chime in, is that this project does not require a supplement because the original approval was for $1,525,354. I'm sorry, let me give you the reference of where I'm at. I'm on ENG 001 SP 05, which is the late file.
Yep.
That we just put onto the record. So, and I am on line 78 or 66, depending on how you want to reference the line in the exhibit 66, but the Excel line is 78. We're speaking about project number 22C712. So this project was approved for $1,525,354. The actual spend, just double check here, life to date spend through May of 2025 is $1.672 million, which is giving us a cost variance of 9.67%. Per our ASP policy, the post-2022 policy, it does not trigger a supplemental path.
Thank you.
Yeah.
I understand all that. My confusion, I didn't expect to see a supplement until the testimony today. It's my understanding that like the reason that this was being discussed at committee was that a supplement was brought forward. So that's why I was just asking. I guess I'll back up. My understanding from what's in the record is that this project was originally approved for $1.525 million. And then on March 27th, 2023, it came before the committee. It was placed on hold, and the reason noted was review reasons for choosing a high-priced contractor with VP of Operations. But then from what I can tell, there is nothing in the record indicating that anything ever changed as a result of this meeting. And in fact, as you just indicated, the originally sought $1.525 million has now been exceeded, although not within the 15% range. Do I have all that right?
That is, from the documentation that you're reviewing, your summary is correct.
I think I may be the reason for the confusion. I think based on what I was reading and before what you said about the fact that there wasn't a supplement, I think I was confused. So I just may need to go back and look at this for what was asked for at the time in terms of or why it indicates supplement in that line.
Okay. We'll certainly take that if the company wants to read that in late at some point in the next 2 hours or however much longer we have of today.
Yes, thank you.
I'll move on to LFE 123 attachment 2.
Before we do that, can we just assign a read-in number? I just want to make sure we don't lose that and keep track of it. And then if we're not able to track down the information while the hearing is open, we'd request permission to convert it to a written supplement.
I would just say, I think I would object to a written supplement on the basis that, we have a statutory right to conduct cross-examination on all evidence in the record, and that right is ending today at 5 p.m. as far as I can tell. So anything that enters the record after the close of this hearing, I'm not sure how it can be in the record in compliance with the UAPA if it hasn't been crossed.
I think the proffer would be chairperson. We will endeavor to provide the specific detail he asked for while the hearing is open for the next, I'm not sure how many hours we're going to be here today. But if we're not able to track that down, I think as Attorney Wheel knows, he can always waive the right to cross-examine if he's amenable to that. And so that was the reason for the proffer. So I think we can revisit it. I think our request would be, let's revisit that if we are at a point where at the conclusion of the hearing, we've not been able to track down his answer.
Okay, so I will just mark this. I believe we're up to read in 9. If my records are correct, I'm not going to roll on the objection at this time, since it may become moot if we can do the read in. So I'll just hold that open and mark this as read in 9 for now.
Okay. Thank you. And for clarity, the read-in the reference would be late file 123, attachment 1, line 11, just why project number 22C712 is marked Vernon Union Street reliability - supplemental when there isn't a supplemental in the record.
Yes, thank you.
Okay, late file 123, attachment 2. So I guess, again, just to sort of set the stage, this late file exhibit was also, being the same late file number 123, was also provided, like we talked about a second ago, as evidence of the cost control exhibited by the company throughout the capital planning process. Is that correct?
That is correct. And this documentation is coming from the company's system of record. Our power plan is where our delegations of authority approvals take place that we've spoken about. And projects are created within power plan. And this is showing you where projects have been, a version of a project has been rejected through that approval process, through the power plan system.
Okay. So this, I think we talked about it a little at the hearing last time, that when the project authorization forms and supplemental that are provided throughout the record, supplemental authorization forms, that there is this sort of preliminary approval process that happens before those forms are ever submitted. And I think I recall that process is sort of documented through the power plan system, and that would be sort of the, do I have that correct?
So when we look at getting items into the power plant system, you want to have projects fully vetted, approved through whether it's sanctioning, all the other discussions that we've had about weekly meetings with managers, et cetera, to get a project that is, I'm going to use the word clean, so that when it goes into the system and reviewers are looking at it, that it can be approved. In this case, what I'm showing here in attachment 2, there were instances where projects were vetted, but folks who were in the approval process rejected it for various reasons. So it could be cost controls, it could be dollars weren't adding up properly, et cetera. But there's a check and balance there of reviewing the documentation that's going through the system before folks are signing off.
Okay. I guess my question is maybe more simple question of this power plan says, like, if a supplemental request form is ultimately developed and submitted for approval, does this power plan process, is this power plan process what ultimately results in the supplemental request form? Like, is this how some is this how someone would initially say, hey, we need to expand scope or budget on this project before the supplemental request form is developed?
The supplement's not kicked off through the power plan system. It is kicked off based on the check and balances of project management, reviewing projects, actuals to budget, and looking at when a supplement might be triggered, or the various other controls that we have in place with weekly meetings, et cetera, where project managers are communicating to management that we are having a challenge and our costs are going to increase, and that would trigger the discussion of when a supplement should be written.
And I'm sorry, just to add to that. So the power plant system is really the repository. It's when you get to that point that you have an authorization or a supplement, it goes in that system to get routed. So it's more of a workflow process.
Okay. I think I'm just going to ask a question about line Excel row 27 on attachment 2 as an example. The note section, again on line 27, says PAF is showing on 52,000 of cost, but power plant authorization is for over 1 million. And again, this question isn't specific about this request, just what's the power plan authorization reference there? And again, the nature of my question is I'm just trying to understand, like, what are these requests that are being captured in this exhibit?
So speaking to this specific example, so the PAF is the documentation, right? And we've reviewed PAFs. And so in the cost summary table, the PAF might have read that it was $52,000 total. And so when the project was routed through power plan, as Ms. Landry discussed, is that it was put through for $1 million. And so when you're doing a check as the approver, you're looking at the PAF, the estimate that's submitted, any other documentation that's in the repository for that project. And what was identified here is that the PAF is showing $52,000, but the request in power plans for $1 million, and hence the job was rejected because we're not comparing apples to apples here. And so a rework needs to be done. It needs to be investigated as to what is the true request that's being asked to be funded.
Okay. So in this instance, like, there was a PAF that was approved, and then the project gets put into power plan to proceed. And this note is indicating that someone noticed that the data that was entered into power plan didn't match the PAF. Am I getting that right?
Right. So someone wrote a PAF.
Yep.
And in power plan, there's an actual estimate that is created within power plan by the cost elements that we spoke about earlier in LFE 118, the various cost elements. And when you look at the estimate, it was totaling $1 million for approval and being rounded for $1 million approval.
Gotcha.
And in power plant, So either investment planning or the plan accounting team is usually the first level of approval. So this one here, Mr. DeRosa is actually gets every single authorization. So he does his review up front to make sure that, as Mr. Ellett said, all those checks and balances and everything make sense in the system. So he's the one who's kicking this out based on, you can see under the approval rejection user that is him.
Okay. I should have started maybe with this question, but a general question, the narrative response back to LFE 123 describes this attachment as illustrating projects that have made it into power plan and were rejected. Is this a sample I guess what's the scope of projects that are included in this attachment? Like, is this a full report of all the rejected projects, or is it like an illustrative example?
No, this report is the raw data from power plant of any projects that were rejected.
Okay.
So this is not a scrub list of any sort. This is coming out of the system. The only thing.
Yeah, I was going to ask, is there like a date filter or something? I just noticed that all the dates like seem to generally be like the last few years, and I assumed that there might be more, deeper into the system than that. Not that I want them. I'm just asking. Just asking if there was a filter on it.
So just to clarify, is it Attorney Wheel, I think, is directing his questions to column F, right, Attorney Wheel, where it says sent for approval? Is that correct?
I was actually looking at column G, but column F also, yes.
Yeah, we were, Attorney Wheel, we were looking for the period for this case since the last rate case. So that's why you're seeing 18 to current.
Okay, understood. Thank you. So then this represents every rejection in the power plant system over that span of time.
Just give me one moment.
Sure.
And I just want to clarify while the witnesses are responding, you said in the power plant system. So that was a limiting part of your question, not in the company in totality. Your question was in the power plant system.
Yes. Based on my understanding that this is a printout from the power plant system, and with the understanding that we just talked about some other rejections from the committee. Yes. So yes, my question is very specifically, is that what this is? The rejections from the power plant system?
Yes, my recollection, this is for rejections from 2018 moving forward. For projects, you'll also notice within this file, you'll see the same project numbers referenced. So there were multiple versions of the project being presented that it might have been rejected more than once at that particular submission.
Okay.
Or for that particular submission, I should say.
Attorney Wheel, is this a good time to take a break?
Sure.
Okay, let's go ahead and take a 15-minute break and we'll resume at 3:20. Okay, Attorney Pace, anything before we resume?
Yes, please. Right before the break, we had a request from the OCC for read-in 9, and then I had raised the issue of can we submit a supplement? I think the issue will now be resolved because Ms. Day was able to track down the information. So we're going to ask her to please proceed to provide in read-in 9 that referred to Vernon Union Street Reliability Project.
Okay, please.
Yes, thank you. I have colleagues who are much better at looking this up than I am. So what happened with this project in terms of its supplements, it was originally approved for an amount, $1,022,217 in power plan in January. And then it went before the sanctioning committee, as we saw in March. When it was in that meeting, it was identified as a supplement. So that's why in those contemporaneous meeting notes, it's identified as a supplement. They went back, and I suppose had that further discussion. It then was rerouted in power plan in June. Instead of being a supplement, though, it was identified as a revised path. And the reason for that is because there weren't any charges on the project. And the only reasons for the increase in charges was that the contractor charges were higher, which resulted in a new estimate. But because there were no major scope changes, it was identified that the proper way that it should be routed through power plan was as a revised path, and that path was approved in June of 2023, including the VP of Operations who had raised the previous issue.
Thank you. I did have one follow-up on that. I'm just trying to find the reference. Do you know if the path that is provided in YGS Capital 3A for that project is the revised path you just referenced?
Yes.
Okay. Thank you. Going back to, or we're still on LFE 123 attachment 2. I was going to just ask some questions that are specifically about the notes in the column, the notes column, which is, I guess, column I? Yes, column I of the Excel spreadsheet. And generally, my questions are about kind of how to interpret the notes. I expect that some of these will be too specific to the project that maybe the panel isn't going to be able to say without looking further. That's okay. Just wanted to highlight that ahead of time. And for transparency, I went through this attachment just like I went through attachment 1, sort of trying to see, okay, where are some of these instances where I can see cost controls? So the notes that I'm going to ask about are sort of in that vein. So Excel, starting with Excel row 6, the note for that rejection says authorization amount doesn't tie to estimate in the documents. Do you know if that means that the amount was too high or too low? Do you know, or is that just is that kind of what we discussed before, that there's just a mismatch between what's in power plan and what's in other documents?
Yeah, that statement or that note is, it could be either way. It could be that the amount that was submitted is too high or too low, but it's rejected because there's a mismatch in documentation versus the authorization.
Okay, thank you. Excel row 12, the note says, please attach detailed cost estimate for review. And there are actually found a couple of other instances of similar notes in here. Do you know if that would mean that a cost estimate that was provided wasn't detailed enough, or that there was no, I guess is this note to be interpreted to say, like, please attach a detailed cost estimate as in you haven't provided any cost estimate, or is it that is it a criticism that the cost estimate was provided wasn't sufficiently detailed?
Based on the note, I couldn't tell you exactly what that means, but I would presume based on who that approver is that he's looking for the detailed estimate that would go with the project, and that it was probably not included when he says attach it. It indicates to me that there wasn't an estimate in power plan. And as we spoke earlier, that you don't just put a paper path in, you have to have the backup that supports your request.
Okay. Thank you. I'm able to skip through some of these because I understand them based on some of your other responses. Rows 21 through 23, the note says system expansion projects have been canceled. Would those have been requests for SEPs projects that were submitted like after Pura sunsetted the program? Is that the reason for that?
Correct. There were projects that the company had identified that were going to be system expansion projects, but based on the wind down and how the companies were to communicate on projects with one last communication of connecting. This was these are residential neighborhoods, so marketing, outreach had not been done. So the projects were approved to be there were viable projects for expansion, but with the wind down, they were ultimately canceled.
Okay. Thank you. Road 25 says, per Tom Costa, this project will not exceed the 10% threshold for supplemental authorization. Is this note, would this be like rejecting a supplemental because it's under the 15 or at the time, the 10% threshold?
Yeah, it would appear by the note and again, the individual who rejected it upon review and communication with Mr. Costa that this project was not going to exceed the policy, and a supplement approval was not required.
Thanks. I have to apologize. I've been doing 2 rate cases back to back, so my dreams are, no one wants to see my dreams. They're this all night long. Very boring. And I confuse sometimes the testimony from different companies, but during the hearing, did we discuss how sometimes project authorization forms or supplements can be in the record even if they don't meet the like $500,000 threshold for a PAF or the 15% threshold for supplements? Is that true?
So I can only imagine what your dreams are like. I'm just doing one rate case and they have not been pretty, Attorney Wheel. So you're correct that while the policy says pre and the post policy state when a supplement is required, project management can write paths at their discretion.
Okay. So this row 25 isn't like indicating that like no supplement can be submitted in power plan. Maybe it's just that this manager determined it wasn't necessary for a supplement. Is that correct?
That's correct. Did not trigger the need for a supplement, correct?
Okay. Thank you. I saw several rows like the very next one, 26, 28, 45, 56, 62. They're the rows that don't have any note in them at all. Do you know why there is no note?
The reason why you're not seeing a note there is that the individual who rejected the version of the request did not put a note in there. So it's a free form field that the individual who rejected could fill out.
And just to add to that, in case it helps, because as Mr. Ellard correctly indicated, it's not a required field, but what happens when there's a rejection is that the people on the chain who submitted it are notified of that rejection. And so having kind of gone through that process myself, usually if you do something like that, the person who has the rejected path reaches out to the person who rejected it and asks for an explanation. That's usually, if it's not included in a note, that's usually the course of what happens.
Okay. Thank you. Row 30, the note says cost reclassed, supplement no longer needed. I think I understand maybe the second part based on the questions I just asked a second ago, but do you know why a cost being reclassed would eliminate the need for a supplement?
Yeah, so you could have a cost that landed on project A that upon review of actuals versus the estimate that charges were charged to the wrong work order. So we reclass the charges.
Okay.
And
So
just kind of building on that, I know you were mentioning cost controls. So in addition to this, there's many other cost controls and oversight. And I think that's a really good example of one because, every month the project managers, the analysts, everybody's looking at these projects. If something's identified on them that applies or doesn't apply, it gets moved. So there is that constant scrutiny that happens month to month as well.
okay. Thanks. So just so I understand the cost reclass, like, I know I'm not going to ask about this project, but just like hypothetically, if a cost were booked to this project that would have made it exceed the 15% threshold, and then the company realized, oh, that was missed, that should have been booked to a separate project. Therefore, the overall cost of this project wouldn't have exceeded the threshold. Am I understanding that's probably what happened here?
That would be correct.
Okay, thank you. Row 40. I think this is a similar one to the very first one I asked about, but it says the estimate and power plan is for, I'll shorten it up for time, $1.8 million, but the amount in the PAF is, $1.85 million, the amount in the PAF is for $1.13 million. These have to match for me to approve. Is this another example like we talked about before where it's just the rejection is that it's a mismatch between the documents?
Yeah, so I'm also a power plan approval, but as Ms. Landry stated, Mr. DeRosiers does a very high percentage of these. So what we do as investment planning is the first approver, we take those paths and we look at the cost summary, financial summary on these paths, and we actually double check the math in the path documentation. So in this case, probably the math didn't tie out in the table for the cost. So Mr. DeRosiers rightly so rejected it because the project's not aligning to tell the complete story of what the project's asking for.
Okay. Thank you. Row 67 says the estimate and power plan needs to show the credits associated with the CIAC. So would that be an example of the estimate and power plan being overstated as compared to the presumably what's in the PAF, which would have shown an offset from contribution in aid of a construction?
So based on that note there, the request is that as part of the estimate is that the CIAC is included within the estimate, which would be a negative offsetting the capital request.
Okay.
And we are authorizing the gross amount as to what the company financial outlay would be for the project.
Okay. And is that the same in row 70? That note's a little different. It says new estimate to incorporate CIAC to be provided.
seems that that would be similar to the previous reference that you had identified.
Okay. Row 72. And I did look at literally every row, but I have fewer questions as we go on because I started to sort of see repeat issues. So we're closer through this than it feels. Row 72 says, need explanation to quantify the overrun and relate it to the incremental work activities driving the price increase. The generic explanation is insufficient. Can you just explain what that would have meant, if you can tell?
That would indicate to me, based on the approver's review of the project, that I'm going to presume that there was a path included or a supplement path, and the approver did not feel that the justification within the path itself clearly communicated what the overrun was, so was not satisfied with the documentation being provided, again, to support the financial request.
Okay. Is it, I think we kind of already talked about this, but it seems like a common reason for rejection throughout this document is generally that there's a mismatch between different kinds of, or at least a mismatch between what's being submitted in Power Plan and other documents. Is that correct?
If I can give that one a shot. So in Power Plan, there's usually more than one document submitted. So I think it's when we have more than one document in Power Plan, sometimes the numbers on those two documents don't match. And I think we have some reviewers that find that issue.
Okay.
I want to note too that the activities that take place leading up to a project making its way into Power Plan are more granular. So there's a lot more project level discussion that happens prior to a project making its way into Power Plan. So the details here in the notes for a more editorial comments. So the conversations that happen about those project level details happen outside of Power Plan. So that's probably why you see that theme.
Okay, thank you.
So Attorney, we'll just build on what Mr. Kruger said. So you had asked earlier, these all the rejections, right? These are the rejections in Power Plant, but as Mr. Kruger said, there's a lot of other rejections before it even gets here that you wouldn't see on this list because it hadn't made it into Power Plant yet. So this is just one subset.
Understood. I saw, I'm gonna get into, well, I saw on row 110, this one says, the note on this one says, 2 revisions were in my queue. I approved version 4, but I'm rejecting the older version 3 to get it out of my queue. And then also another example on row 118, it says duplicate revision sent for approval. So there are a couple of notes that seem similar, and I just wanted to confirm is like what's happening here, just that they're like they're requests within Power Plan that have already been addressed.
So what the comment on line 110 is referencing is that every time a version of funding request is made in Power Plan, there's a version created. So in this case, as it's laid out here, there was a version 3 submitted and then a version 4. When you're a Power Plan, when you're an approver in Power Plan, your desktop queue says, I have to approve 10 projects. And in this particular case, the approver is noting that he has 2 versions in his queue, and to clear his queue so that, because we're also looking and double checking that projects are being approved, because no project will be constructed without its initial approval being run through Power Plan, that he's rejecting one of the versions to get it out of his overall queue.
And I just want to add, you can tell this person is an experienced reviewer because, like, as I mentioned, when you reject something in Power Plan, the person who submitted it gets an email that happened, And they usually don't remember exactly what the last version was that they submitted. So they just get that email that it's a rejection, but because the reviewer includes that line, they know that the other one was approved. They don't get confused or flustered.
Okay, that makes sense. I mentioned row 118 before. It says duplicate revision sent for approval. Would that be like a similar reason?
Yes.
Okay. And like I think I mentioned before, I'm trying to ask questions that I think apply to more than just the lines I'm asking about, so that we don't have to sit here and address every single line. Another sort of common reason, as I understood it, for rejection seems to be that like a project scope might be changing soon. Line 102 is an example of that. So my understanding of this note is as new PAF coming for full scope. My understanding of that is that this was rejected because the approver like knew that there was something like an update pending. Is that correct?
Yeah, I think I think it speaks to what both Ms. Landry and Mr. Kruger stated, that there's many conversations and processes, and these projects can be iterative in terms of how they get to power plan. So through other meetings that took place, it was communicated to this approver that I have a path in the system. However, it might have been for initial funding, for example, maybe doing some engineering work or some other sort of work, but they now have a full scope. And instead of putting it in for, a dollar amount of X, or the scope has been completed, as Ms. Day described in her read-in about a project that didn't have any cost attributed to that project, that the path was being revised and then submitted for approval.
Thank you. So row 135, the note, this is my favorite note that I found in the document, because this is like the golden nugget I was looking for, I think, because what this says is $80,000 too high of a request for preliminary design work with no documentation. Sounds like the OCC wrote this note, right? So does this mean that this was rejected essentially because this just seems too expensive without more documentation? Is that correct?
Yeah, that's your golden nugget that you're looking for. Yes, that's exactly correct.
Okay. Thank you. So because I was so excited about this note, I checked, that's for project number, again, it's row 135, it's for project number 24C604. And I did the same thing that I did for the last kind of project that we talked about, where we ran down through the documentation. I found that this does have plant in service. When I wrote up my questions, I hadn't looked at supplement 5, but this is ENG 001 supplement 4, attachment 1B, line 451. And the documentation reference for that is ENG 001 supplement 1, attachment 2B, page 647. So I did have some questions about the project as it's presented there. I can read that reference again if you need it.
Yes, please.
It's ENG 001 supplement 1, attachment 2B. And the page number is 451. Sorry, 647. And I think everyone's still trying to chase down that.
Yeah, I'm so sorry. Would you mind reading it again?
Sure, no problem. It's ENG 001, the first supplement, so SP01. And this was, I'm reading at the top of this is December 16th, 2024, if that's helpful for chasing it down. And it's attachment 2B.
I've got it. Thank you.
Okay. And page 647.
Yes, we're there. Thank you.
Sure. So the first thing I was curious about, because I was, again, trying to kind of interpret the LFE 123 attachment to, I was trying to kind of figure out like what this was showing for the power plant output. So I looked at the dates first. So referencing back to the 123 attachment to line 137, my golden nugget comment, that was submitted on January 19th, 2024 and rejected on my birthday, actually, January 23rd, 2024. It really is. It's like it's made for me. And I noticed that the PAF on ENG 001 supplemental 1 attachment 2B page 647, that was prepared March 29th, 2024. So a couple months after the power plan rejection. Is that right?
Yeah, following your dates, that's what we're showing.
Okay. I just wanted to confirm, and I'm sorry, I'm not trying to be dense. I just want to make sure I understand like the internal process of like, so this seems like a circumstance where there was this submission and power plan. It was rejected on the basis of the internal design costs being too high. And then a couple of months later, there's this PAF. Would there have been a PAF like before the power plan submission that was revised? Like, is this a revised PAF or is this the first PAF for this project?
This would be a revised one. So the fact that, and I'll let Mr. Ellert chime in too, but the fact that it has the same project number and also reading the notes from LFE 123 attachment 2, which specifies that it was originally a request for preliminary design work. So that is sometimes how we will submit paths for projects, kind of an initial path for design work. As indicated, that was too high. So it appears to me that the engineering team went ahead and did some design that led to an estimate, and then they resubmitted a path under that same project number, which included a fuller estimate and presumably a more detailed scope of the project.
Okay. Thank you. So I tried based on this path to figure out like I was excited to see, so like what was the preliminary design work cost that ended up happening since 80,000 was too high. And I can't tell from here. So on page 648 of this exhibit, there is a line item breakdown that includes internal labor, outside services, materials, et cetera. I also looked at, and this is the redacted version I'm referencing now, but it was filed confidentially, and on page 651 and 652, it looks to me that there is some evidence of design work on those pages, but I couldn't tell. Does the panel know like what the preliminary design work cost for this project ultimately was?
1 minute, I'm going to see if I can find something for you.
Sure.
So subject to check, and I have some people checking for me, so hopefully I'll be able to give you that check soon. But I think what likely happened here is that the path, which was for a preliminary design cost, indicates that they were going to go out to bid to engineering contractors to do that initial design. And instead, we used internal employees to generate a detailed enough design for a more complete path. So that doesn't mean that they didn't then use contractors for more detailed design, but kind of the pathway that they chose to get funding approval changed.
Okay. And would that internal design work be included within, on page 648, it shows internal labor and construction equipment of $6,449. Would that include like the capitalized labor for that design work?
I think instead, and I will let my finance team correct me if I'm wrong, it would be included in the indirect capital cost, the indirect and overheads, including benefits, would be where the engineering direct labor would be charged.
Okay.
Yeah, Attorney Will, Ms. Day is correct in her response.
Thank you. So it would be somewhere within the 96,000 figure within year 24 on that page?
Correct.
Would there have been other indirect overheads other than preliminary design work in that?
Yes. There's even just within the engineering department, there could be other overheads that are charged in a very small amount to that capital project.
Okay. So that was actually my last question for this panel. I am still curious if like the company is able to identify what specifically the internal engineering costs were, like within that indirect and overhead amount.
The internal engineering costs include procedure creation. So each project that gets designed, we would have a full suite of drawings with details for the offsets. So in this particular case, there was 2 offsets around catch basins where our facilities were damaged by the contractor that was performing this work for the municipality, installing the drainage basins. So we were in a position that we had to redesign our gas system to allow for the drainage system to be constructed. And part of that pricing, we do have the need for procedures. So we would perform live gas work as well as abandonment procedures that the crews would have to follow step by step that I talked about earlier in today's discussion.
And I think maybe what you're getting at, right, is we had an idea that we would have an initial project design that would be $80,000, and that was too much. So then what was the ultimate project design cost? So I think the other place where that could be in this estimate is in the outside services, if they had still decided to use an outside engineering contractor to develop those designs. So I think what I can try to do is pull up the estimate. And depending on how long that takes me, we may need to make it a supplement.
And I'd like to add in that preliminary design, when we go through these municipality DOT projects, we often have the need to perform test holes. So when we do test holing, that allows us to get precise locations of our facilities to understand the depths of the gas main, the depths of any services, because when these municipalities are installing drainage, they have to go at certain depths. So the inverts of those drainage pipes, the reinforced concrete pipes, have to go over the gas main. So we have prescribed separation between those facilities and our gas facilities being 12 inches. So when we perform these test holes in advance during a preliminary cost, that's what we would have prior to understanding the full scope of the project. So that's likely what the 80,000 included, test holes for us to understand so we could design full scope for these two offsets.
Thank you.
So on this one, what we had offered was, I'm not sure how much time we have left today, but my witness had offered to do a read-in. But if we reach a point where they've not had enough time to do that, our offer still stands, which is we're happy to provide a written supplement. And if the OCC wants us to come back and the authority agrees with that, I can produce a panel at a date in the future to answer a question about the supplement. We're willing to do that just to make sure we give the answer.
To be clear, the reason that I'm objecting is to preserve my objection now, because if I don't object now, then there's nothing in the record suggesting that we have any problem with a document coming into evidence at the close of the proceeding. But I'm like subject to that objection, which again is based on we just need to preserve the right to cross. If the company wants to submit something and we can look at it and determine whether we would waive our right to cross, in which case we wouldn't object to it being in the record. But if we would like to cross on it, I think we'd have to figure out something in order for it to sort of be admissible at that point.
So if I could play that back, Chairman, we're happy to, as we said, commit to do a read-in today. But again, we don't know how much time we have left. When we reach a point at the end of the hearing, we're happy to, if we don't have it yet, we're happy to say we're willing to provide it as a supplement. And then once the OCC sees it, if they're fine with it, then I think the issue's been resolved. And if they feel like they want more due process, they can petition the authority for what that process is, and you can evaluate their request at that time. So that we're willing to offer that, but ultimately the authority can decide how you'd like to move forward.
Thank you. So we can mark that. I'll take care of the first things first. We'll mark it as read in 10, I believe. And then again, I'm not going to rule on the objection just yet. We'll take this up at the end of the hearing if the read-in is not available.
Thank you.
Thank you. And yeah, to capture the read-in, the question is what the ultimate preliminary design cost for project 24C604 was. Is that correctly phrased, Ms. Day?
Yes.
Thank you.
Okay. Thank you.
And that's OCC's last question for this panel. Thank you.
Thank you. EOE. Thank you, Attorney General. Thank you. Any questions? I don't have any questions for this panel. The company would like a minute to consider redirect.
Yes, please, very briefly.
Sure.
Thank you. Thank you for the chance to consult. The good news I have is we have no redirect examination for this panel. Thank you.
Thank you. Okay, then according to my records, we have one final panel on page 14, the company's cost of capital panel. So, and request that the company's witnesses for the cost of capital panel please approach. Okay, Attorney Tisler, please.
Good afternoon to the panel. Would each of you please state your full name and position for the record, starting with Mr. Horton?
My name is Doug Horton. I'm the Vice President of Distribution Rates and Regulatory Requirements for Eversource Energy Service Company.
Jonathan Callan, Manager of Financial Analysis for Eversource Energy Service Company.
Good afternoon, Mike DeZilo, a Principal Analyst in the Corporate Finance and Cash Management Group of Eversource Energy Service Company.
Good afternoon, Rima Hyder, Vice President of Investor Relations for Eversource Energy Service Company.
As part of your preparation for this late filed exhibits hearing, did each of you sponsor or co-sponsor responses to late filed exhibit requests issued during the course of evidentiary hearings in this case?
Yes.
Yes.
And do you have any corrections or clarifications to any of your late filed exhibit responses not previously identified?
Yes.
Mr. DeZilo, can you please provide your update?
Yes. In late filed Exhibit 49, Yankee discussed the planned issuance of $185 million of first mortgage bonds in 2025. On June 24th, 2025, Yankee priced $185 million of first mortgage bonds in two series. $148 million of 5.02% first mortgage bonds due January 2nd, 2031, and $37 million of 5.55% first mortgage bonds due July 15th, 2035. The transaction is expected to close on July 15th, 2025. As a result of those developments, we expect Yankee's cost of debt for this $185 million bond issuance to be lower than previously projected. The company can file information about the terms of the issuance and the actual expenses incurred into the record on or about August 1st, 2025.
To the panel, do you adopt your late filed exhibit responses as part of your sworn testimony in this case?
Yes.
And Mr. Callan, as part of your preparation for this hearing, do you also prepare supplemental interrogatory response RRU-070-SP03?
Yes.
And do you have any corrections or clarifications to any of your supplemental interrogatory responses?
No.
And do you adopt your supplemental interrogatory response as part of your sworn testimony in this case?
Yes.
And Mr. Callan, are you familiar with the recent Moody's credit downgrade for CLNP provided in the record as LFE -133 SB01 attachment 1?
Yes,
Do you have any comments on why you provided this in this proceeding?
I do. This opinion includes discussion, a lot of discussion of Moody's current opinion of Connecticut. And their opinion matters because obviously investors look to them to understand risk. So Moody states on the first page of that attachment, the downgrade of Connecticut Light and Power to Baa1 primarily reflects a Connecticut regulatory jurisdiction that is currently the least credit supportive utility regulatory environment in the US. This environment has been characterized by higher political scrutiny as well as inconsistent regulatory decisions and rate case outcomes. They go on to say on page 2, CLMP's stable outlook reflects our expectation that the utility will maintain a ratio of CFO pre-working capital to debt, at least in the high teens, with its FERC-regulated assets helping to offset the challenges under the Connecticut regulatory environment. At the same time, the stable outlook reflects the company's ongoing effort to rebuild its relationship with key stakeholders, including regulators, state leaders, and customers. So anyone can read that information and attempt to draw whatever conclusions they want, but to do that is to miss the point of these reports. Customers are paying Moody's. Customers in this case are the debt investors. They're paying Moody's to understand risk. It doesn't really do them any good if the report requires that they read between lines or connect imaginary dots. So the intention is transparency. So if Moody's is saying the downgrade is because of the Connecticut regulatory environment, that's what they mean. And then the last point I'd like to make is that is the lack of a downgrade for Yankee Gas in this particular opinion is not, it's not indicative of a lack of concern or even surprising really, because Moody's, all three of them, Moody's, S&P, and Fitch, they prefer to wait until facts materialize instead of acting first or acting quickly based on speculation of some highly uncertain future event like a rate case, and then potentially having to act again when they do have the facts. So that's you would expect there to be no action today. They're going to wait until, or Tuesday, I guess in this case, they're going to wait until there's a decision in this outcome to act on Yankee Gas. So the bottom line is rating agencies are paying attention and investors are paying attention to them.
Thank you, Mr. Callan. This panel is available for cross-examination. However, before we commence cross-examination, I do just want to raise that consistent with the comments of Mr. DeZilo, we would ask for permission to allow the witnesses to update LFE 49 on or after August 1st, 2025 to reflect the actual cost of debt for the debt issuance based upon the expectation that it will go down based on the estimated costs that the company has presented through the update. And of course, that's at the discretion of the authority if it deems it appropriate to provide an update at that time.
Thank you, Attorney Tisler. I don't know that the authority is prepared to rule on that, but why don't we treat it this way? We'll invite the company to make a motion at that time, and then we'll follow our normal, if you file the LFE 49 as an update, as a motion, and we'll allow our normal process of other parties and interveners having an opportunity to object before the authority issues a ruling at that time as to whether to admit. And I should have interrupted earlier, but Attorney Tisler, I believe all of these witnesses were sworn already, right?
That's correct.
Okay, thank you. Just want to note that for the record. Okay, am I forgetting anything? No, so I think we can move into cross-examination for the panel. Is there? Any cross from the E EOE? Okay, sure. Attorney Wheel, does the OCC have cross of this panel? Okay, thank you. We'll ask OCC to approach, please.
Hi, Tom Wheel for the OCC. This actually won't take very long. I was trying to hear the read-in, and I just wanted to confirm, could you run through again the update on the bond issuances?
Sure. So it was an aggregate of 185 million issued, and that was in two series. The first was 148 million of 5.02% first mortgage bonds due January 2nd, 2031.
I'm sorry, 5.002.
02%.
Okay.
And those mature on July 2nd, 2031. The second series was 37 million of 5.55% first mortgage bonds due July 15th, 2035. And the transaction is expected to close and fund on July 15th.
Okay. And you mentioned something about the a bond issuance being lower than expected in the future? Can you?
Correct. Relative to what we had previously included in the D schedules.
Okay. Thank you. I did have just a couple of quick follow-up questions, Mr. Callan, about the last thing that I think you were talking about in your direct. You mentioned that the credit rating agencies are likely to wait until the outcome of this rate case to decide the action on Yankee. Is that correct?
Yes.
Okay. Do you know what PURA decision triggered the CLMP report from Moody's the other day?
What PURA decision? No, I don't.
Didn't that report reference CLMP's outstanding storm deferral?
Okay, so not a decision then. It did. It referenced CLMP's debt. I believe it also referenced its deferral balance fluctuations over the last 2 or 3 years. It cited, I think, 13%-ish range for CFO pre-working capital to debt 1 year, and then 23% another year, which a fluctuation that pretty much indicates the sort of volatility that would lend itself to a higher risk.
And it also mentioned that virtually all other state regulatory jurisdictions provide their utilities with much more expedited and timely recovery of costs incurred during storms as it relates to the storm balance.
Thank you. Is there a proceeding before PURA right now evaluating that storm deferral in Connecticut?
There's two proceedings, I would say. There's the proceeding that's evaluating the prudency of the underlying storm costs. CLMP has tried repeatedly to have PURA evaluate the recovery or the replenishment of the severely depleted storm reserve, and the last 2 RAM proceedings demonstrating that customers stood to save about $1.5 million every month if PURA were to authorize that replenishment, and it's thus far refused to do so.
Thank you. I was just confused, Mr. Cullen, by your assertion that credit rating agencies tend to wait until the outcome of regulatory decisions. Can you just clarify, given that PURA, as Mr. Horton just testified, there's a pending proceeding as to the prudence of storm costs, which will affect presumably the allowed revenue for that. Why did Moody's not wait for the outcome of that decision before adjusting the credit outlook based on the storm costs?
I'd say the way I interpret that to mean that their concern for CLMP had grown so significantly that they're no longer ready to wait. With Aquarian Connecticut, for example, they didn't make their decision. They didn't downgrade Aquarian Company of Connecticut until after the decision, which was in 2023. They downgraded afterwards. So even if they had concerns at the time, they still waited for the outcome.
Okay.
And I think, I'm sorry, Attorney Wheel, I just wanted to clarify, because I think important distinction. What I said is that PURA is currently evaluating the prudency of the storm costs, but the Moody's report notes that recovery, which is a key element for a credit rating agency, is the cash flow associated. So at this point, they're seeing on CLNP's books a significant negative as being that the company has expended cash to the tune of $1 billion plus in support of storm restoration and has no path, despite multiple attempts, to get replenishment of a storm fund for recovery until some date into the future. In the note, the sentence prior to the one that I quoted, starting with the word virtually, every other jurisdiction has more timely recovery for storms. They noted that, quote, however, the timing of this recovery will not be established until a formal rate case proceeding is filed, which we expect to occur sometime in late 2026. And so from their perspective, it's the prudency review is one thing, but it's the replenishment of the storm fund that would be cash positive. Right now, there's just a significant negative on the balance sheet for CLMP.
And one of their concerns you just said is the timing of the filing of the rate case. Is that correct?
It's the timing of the recovery of the storms.
Could you just read again? I apologize, what you just read.
Sure. So it says, I could read the whole paragraph. There are several critical state regulatory and legislative actions that could impact CLMP's credit profile over the next 2 to 3 years and highlight the credit risks and regulatory lag that the utility faces. CLMP's ongoing deferred storm cost prudence review is currently pending with the Public Utilities Regulatory Agency, or PURA, in which the utility has requested review of approximately $800 million of deferred costs related to storms from 2018 through January 31st of 23. PURA's decision is expected in the third quarter of this year and will determine the amount of costs that are deemed prudent and ultimately be recovered by CLMP. However, the timing of this recovery will not be established until a formal rate case proceeding is filed, which we expect to occur sometime in late 2026. Virtually all other state regulatory jurisdictions provide their utilities with much more expedited and timely recovery of costs incurred during storms.
Thank you. I mean, so doesn't that say in clear, unambiguous language that the timing concern is related to the filing date of the rate case?
It says that the timing will not be established until a future rate case proceeding is filed.
Okay. And Mr. Callan, you mentioned a moment ago that from your perspective, the reason for Moody's to act now, and I don't want to put words in your mouth, my understanding of your testimony is that they are so concerned for CLMP that they can't wait for the outcome of the rate case. Is that correct?
I mean, that's how I would summarize it. There hasn't been a rate case and they're making this decision anyways, so I'm not sure how else you want to look at it, but they do say pretty clearly the downgrade of Connecticut Light and Power to Baa1 primarily reflects the Connecticut regulatory, so on and so on.
Okay. So is it fair to assume then that they aren't so concerned about Yankee Gas that they can't wait until the outcome of this rate case then?
I think that's fair to say they are less concerned because of Yankee Gas's leverage, maybe relatively, but that doesn't necessarily mean they're not concerned. And seeing as, you know, it's June, this was dated June 24th, so they could act now and potentially have to change course, either downgrade again or go back up or whatever. They could do anything in another 4 months or so. Whereas CLMP, whatever that timing is, it's a lot further out than 4 months. So.
Okay. Does the fact that Yankee has secured debt at a lower rate than it projected have any bearing on the risk profile of Yankee?
Mike could probably speak to why it's lower, but I don't think it's indicative of Yankee Gas's spread relative to treasury rates, and maybe the treasury rates are lower than we thought they were going to be.
Right. I think it's primarily a function of Yankee had originally projected to be issuing 30-year debt. As it turned out, we issued 5.5-year and 10-year. So I think that's a key driver of the lower rate.
Okay. So there are factors other than credit ratings that can affect the cost of debt then?
Correct.
Great. Thanks. No further questions.
Thank you. Attorney General. Thanks. EOE. Sure.
Honestly, I could have done that from over there and I don't need my laptop.
Just, you were reading, when you were speaking with Attorney Wheel, you were reading from the Moody's, did you say that was going to be filed as a supplemental? I don't know if I missed it.
It is filed.
Oh, that it is filed. Okay.
Yes, it is.
That was it. Thank you.
Certainly.
Thank you. I don't believe authority staff have cross questions. Oh. Sorry, did I miss somebody? No. Oh, you have questions? I don't have any questions. Thank you. Attorney Pace, do you need a moment to consider redirect?
Yes, I'll be very brief, just a short moment. Thank you.
Sure.
I have some brief redirect. Mr. Callen, do you recall the conversation you had with Attorney Wheel regarding Moody's decisions that occurred just a moment ago? And do you have anything further to add for the record regarding Moody's that you can share at this time?
Yes. So within the last month or so, we met with Moody's to discuss various things, but the forecast, the company's current position. They specifically told us that they were going to wait for the outcome of this rate case. And the things that they're going to be looking at are things like the revenue requirement, the degree to which it, facilitate, or the degree to which it enables the company to achieve its allowed ROE, the allowed ROE itself, cap structure, and cash flows overall. And so the bottom line result, basically.
And Mr. DeZilo, do you recall the conversation you had with Attorney Wheel regarding the cost of debt in the upcoming issuance?
I do.
Okay. And did last year's downgrade of Yankee impact the cost of debt in that upcoming issuance?
Yes, as a company's credit ratings are lowered, its cost of debt capital increases. And again, as I mentioned previously, it was lower relative to what we had projected simply due to the fact that we issued shorter term debt. But again, all else equal, because of that downgrade, it would have been more expensive.
Thank you.
Is that it? That's it?
That's all.
Thank you. All right, thank you. This panel is excused. Let's turn to administrative matters. And first, can we just make sure we're on the same page about open read-ins? Attorney Pace.
Thank you, Chairman. I believe the only open read-in that we have is the one that came up just very recently, and which was marked as read-in number 10, and it referred to ENG 001 SPO1, December 16, 2024, attachment 2B, page 647. And I'd like, if I could, to ask my witness, Ms. Day, to please approach the podium to see if we do have the read-in, and if we do not, we're going to request permission to submit that as a written supplement.
Thank you, Ms. Day.
Thank you. I'm sorry to say we were not able to get that information, so I would appreciate if we would be able to provide it as a supplement.
Okay, thank you. So let's do this. I think we have, with that added to the supplement list, I think that brings us to a total of over a dozen supplements. 4, 5, 6, 7. Okay, apparently it's too late in the day for me to do math, but over a dozen supplements. Ms. Day, you can probably be seated. Thank you. So let's do this. We'll get to the date of the supplements in just a second, but process-wise, we'll ask that the company file the supplements, and then within 2 business days, I would ask any party or intervener to file an objection if there is going to be an objection, or characterize it as a request to cross, and then we can sort it out from there. So let's turn to the date on which the company thinks that it can provide these supplements, because we will need to make some adjustments to hold the record open for those.
Could I have a moment to confer with Ms. Day for a moment?
Sure.
Thank you.
Bless you. Bless you.
Thank you for the chance to consult, and I really appreciate that. Just the issue that I confronted just in terms of polling my clients, is with the July 4th holiday next week and also availability of personnel. But obviously, we understand that we have the burden of proof, and we appreciate the opportunity to be able to submit the information. What we'd like to query is, do we have permission to submit these with the furthest date being Monday, July 7th? If things are ready sooner, they'll be filed sooner. And I just wanted to see what the authority's reaction is to that proposal and reaction from other parties.
Okay, you invite other parties to approach. I would caveat this by saying I want to note that the briefing date of July 28th, there is no flexibility in that briefing date, given that we have a competing rate case on the exact same timeline. So I just want to caveat folks weighing in with that. So especially if we're going to, and this bit speculative, if we're going to find ourselves in the position of having an objection to evidence and then wanting another hearing, if that comes to fruition, even then, we will not, I think you have a majority of commissioners here that are telling you we will not extend that briefing date. So I want folks to weigh in with that in mind. I recognize I do think I added up 14 supplements. So invite other parties and interveners to weigh in, but I just want you to know the briefing date's July 28th.
Chair, if I could offer one additional comment before the parties react, and thank you. We're not looking for an extension to the briefing schedule. And the other point I think that may be helpful as parties think about their reaction to your question is, it appeared to me that the supplements were very specific, detailed information. And of course, we have briefs that are going to talk about evidence filed over months. And so in our view, we'd like the parties to take into consideration with our offer that if things are ready sooner, we're going to file them sooner. But the 7th, which would be a Monday, would be the latest date for anything to come in. So thank you for the chance to offer that additional context, and the parties can react to what the chair had raised.
Thank you, Attorney Wheel.
Yeah, we don't, I mean, with the acknowledgement the company can only do what it can and the time it can do it, and with the recognition that there is this immovable brief deadline, as so long as we preserve our right to object, I guess without knowing what exactly the supplements are going to say, it's possible that we might form an objection on the basis that even if there were a hearing, we don't feel that there's enough time for us to be able to, incorporate these issues into our brief. Again, I don't say that with any supplement in mind. I doubt that will be the scenario, to Attorney Pace's point of the contents of the supplement, but there's a long way of saying so long as we reserve the right to object on whatever basis is acceptable, I mean, whatever basis is the authority can consider, then we can work with the 7th.
Okay. Would any other party or intervener like to be heard? Attorney Wyman.
Like to preserve our right to object if necessary.
Thank you. Anything further? Attorney General, is that a third? Okay, you got that. Okay, thank you. Okay, let's do this. I will set the supplement date as Monday, July 7th, absolutely no later than 4 p.m. with whatever can come in sooner, filed sooner. We'll note that we'll just have to deal with any objections that come. The briefing date of July 28th, everyone is always welcome to make a motion. But July 28th is the briefing date.
Well, thank you. That's very clear. And we're not looking, at least Eversource is not looking for a change to the briefing schedule. Thank you.
Okay. Thank you. So what else? I think I have covered the briefing date as the next step. Are there other open administrative matters? Attorney Pace.
We have nothing else. Thank you.
Thank you. Any other party or intervener? All right. Thank everyone for your participation in this portion of the proceeding. We are adjourned. Thanks.